Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
This is Bloomberg Surveillance. Tom Keene, Jonathan Farrow, Lisa Bromwich, Todd and John are off suspiciously on the same day that the U.S. is playing England in the World Cup. I'm looking right now at Burger's Smokehouse Herkery smoked whole turkey that went for $159 currently on Amazon.com with lots of good deals. Damian Sassower in with me. So I can tell you all of the good deals that you could potentially get on turkey.
I love a baked ham.
Yeah, that was a great pun. You know, never getting turkey again, clearly.
Maybe I should have ordered Chinese food.
We're looking at markets that are very quiet on this post-Thanksgiving day. Not a lot of action, but a real reset. And I think that the story of the week, Damian, has really been how much yields have come in, this feeling of a Fed pivot, the idea that the end terminal rate will be lower than what people thought just a week ago, somehow a rebuttal of everything that the Fed Chair Jay Powell said at the last meeting.
Yeah, and you're finally seeing it. You're seeing people push out on the curve. They're taking more duration risk into their portfolios. The asymmetry in fixed income has improved materially just in the last week alone. So, look, we were long calling here at BI for a rally in fixed income. I think we're going to see it here in 2023.
Well, you don't think you're going to see it?
I think we're going to see it.
Yeah, a lot of people think so. And this is really the issue, is that the people think we're heading into weakness. And yet, today's Black Friday. A lot of people are going to be shopping. A lot of people already shopped. A lot of people aren't going to shop because there are going to be so many deals in a week.
Coming up, more promotions.
I mean, how much do you actually see that resilience of a consumer as a bad thing, or do you see it diminishing?
Well, what's interesting is this is going to be the first time in 3 years where you actually have physically people going to a store to purchase things as opposed to doing it online. The foot traffic is going to be the key indicator. I'm going to be very interested in seeing, people getting out of bed and actually going to the store and actually touching and feeling and buying. I don't know. I mean, the verdict is still out for me. I probably am a little bit pessimistic on that and how the holiday period is going to be from a sales perspective. But, a lot of people are looking forward to good things.
So let's head over to the ground and see whether people are shopping and doing things. Bloomberg's Kriti Gupta is out there, toasty and warm in New York's Herald Square. Thank you so much for being with us, Kriti. What is the scene? Are there a lot of people out there actually shopping, or is it kind of sleepy?
There were a lot of people shopping. We had an amazing line, and then 6 a.m. hit, and they all kind of flooded straight into Macy's. So now you have an empty Herald Square. To Damian's point, actually, that a lot of people aren't necessarily shopping in person, but there was a good turnout. I think what's really key here is the idea that they are looking for that in-person experience. A lot of the people here specifically are going to be tourists, so that kind of trying clothes on, looking at perfume, looking at jewelry in person, those kind of things are experiences that they want ahead of the holiday season. But I think the really crucial takeaway is that this is really becoming a litmus test for a lot of these retailers. Can they get rid of the inventories fast enough at those higher markdowns while still being able to kind of maintain their bottom line? This is going to be a really crucial kind of moment for a lot of these retailers to say, are we ready for the holidays, and are we ready to accept new shipments?
So, Kriti, you're in front of Macy's, you're on the west side, you're in the 30s. Talk to me about not just Macy's. I mean, people are obviously trading down to, other brands. Talk to us about what you're seeing on, on Broadway in that area. I mean, are you seeing, is it just Macy's that people are waiting in line for? You see people, kind of crowding to other places? What's the vibe?
Well, look, I'm just a few blocks away from Times Square here. You do have Macy's, which, of course, caters to a more higher income clientele. But right next to Macy's, by the way, is an H&M. And H&M is fairly not in the same category, I would say, as Macy's is. And you are actually not seeing the same line. So I wonder how much of this is going to be more of a story of this divergence that you're starting to see between different income brackets. And remember, this is something you're hearing on an earnings basis as well. The idea that Macy's actually said, well, we're actually okay with higher inflationary pressures because we do have a higher income client that can absorb that. That is something that not a lot of other brands and retailers are really saying. You saw that with Target. You even saw that with Nordstrom, arguably, that the wealth effect is going to be far more evident here as you start to see those divergences between a lot of the retailers. Dana Telsey, I believe on Surveillance last week, actually said that, hey, look at Abercrombie & Fitch, look at Anthropologie. Even the kind of bid from your teenage shoppers isn't as prevalent as it was, say, a couple years ago.
Well, Critty, I mean, the big theme here has been, clearing of excess inventory, right? And that's still a big one for retailers. Talk to me about, skinny ties and slim-fitting suits for men, men small. I mean, Jonathan's just typing in here. He's looking for some skinny ties. I mean, what are you seeing there? Any inventory on the racks?
Yeah, he IB'd me and said, these are the colors I want, go into Macy's and reserve them before you start doing your hit. But this is interesting when you talk about the inventories because, look, this is the real Achilles heel for a lot of these companies. If you're looking at it from a stock price perspective, Damien, Lisa, I'm a market scout, they're getting rewarded if they're able to clear their inventories. But if you look at it from a profit point of view, from their balance sheet point of view, that's really where they get hit. Because if you have higher markdowns, higher promotions, at the end of the day, you're not making as much on per unit item. And that's going to be the Achilles heel for a lot of these retailers, even if they are rewarded for getting rid of that inventory in the stock market. That's going to be a really crucial balance going into 2023.
Critty Gupta, thank you so much, and we will be hearing from you throughout the day. We are looking for seasonal sales potentially falling 1.2%, this according to S&P, which would be the first decline since 2009 after you adjust for inflation. Joining us now is someone who's really parsed through the fate of the consumer amid inflation before it might even get to some of the underlying data that the Fed looks to really gauge inflation. Claudia Sahm, founder of Sahm Consulting and former Federal Reserve economist. Claudia, thank you so much for being with us on this post-Thanksgiving Friday. How much are you looking to this holiday shopping season as a gauge of consumer spending?
I'm really optimistic. Consumers have delivered this year. We have had a very steady pace in terms of overall spending, and the labor market is great. I worked at the Fed over a decade focusing on consumer spending, our forecast, our analysis. People, when they have income, they spend it. Americans have income, these jobs. It's true, some of the spending now is going to be at the higher end, but you know what? Those people that work at Macy's, they need to keep their paychecks. They need people to come in and spend. We have everything for another good holiday season, even after inflation adjusted. So I see a really good path forward. And honestly, I'm not too worried about some of these businesses, the big businesses, taking a little bit less in profit. They've been doing pretty well, but you got to look big picture here.
But Claudia, on the flip side, you could say that resilience, that spending is exactly what's causing a problem for the Federal Reserve, because it's the reason there's still momentum, the reason that inflation can last longer than many of the lower income families can stand it. How does this really cohere with this idea that the Fed should be somewhat careful rather than just keep going with the sledgehammer?
The Fed needs to back off. It is absolutely clear and has become clear over time. A lot of that inflation is coming from disruptions on the supply side, disruptions from COVID, disruptions from the war in Ukraine. We have seen a lot of encouraging signs, even in the last consumer price index numbers, that things are turning over. We're seeing things work themselves out. Yeah, it's going to take time to show up in consumer prices. For whatever reason, the Fed has decided they got to see it there, even though we see it in producer prices, import prices. Rents are turning over. Like, we have all the signs that relief is coming to consumers. And if the Fed does too much, they're going to undo that relief and overdo it.
Claudia, the Sahm rule has been, it's a widely regarded indicator of recession. You know this, you created it. My colleagues at Bloomberg Intelligence are calling for a 100% probability of a recession in the U.S. over the next 12 months. What are your thoughts on that?
So respectfully, I disagree with them. And frankly, as the data are coming in, particularly on the inflation side, I am more and more encouraged that we could skirt the recession. I think if we see one, it's almost absolutely going to be of a mild variety, at least given what we know right now, right? Other bad things could happen and that forecast could change. But we have, again, there's a lot of encouraging signs. The labor market is good. The Sahm rule is based on the unemployment rate rising. And it's really not. Things look really good in the labor market. We're getting back to a more normal, sustainable pace. So I don't see it. And less I'm seeing it. But, I have been wrong multiple times. This economy is upside down and backwards. And we keep having really bad luck in terms of bad things happening in the world.
You know, Claudia, you've also written extensively on Fed activity during periods of wartime, right? And historically, what we've seen, like in World War II, for example, you saw, basically the Fed not, hiking rates as aggressively, providing income support and the like. You know, we just saw, roughly 70% of the power to Kiev knocked out in Ukraine yesterday. We know the difficulties that are going on the ground there. What should the Fed be doing? Should they be paying attention, and how should they be handling that?
Congress should be stepping in. And the Federal Reserve is following their mandate. That's what they have to do. They're going to follow the letter of the law here. In wartime, you can look back to World War II, that was a time when the Fed worked closely with the Congress, and Treasury told them, you are going to keep interest rates low, so financing the war doesn't cost American taxpayers even more than it has to. The independence of the Fed is not God-given, it is Congress-given. Now, that's a big step forward, and I know even talking about it is like, wow, a Fed economist is talking about, putting independence temporarily on the side. I don't get it. I don't get why the Federal Reserve is pushing so hard, and I certainly don't understand the European Central Bank and the Bank of England. Like, this is making a very bad situation in Europe worse.
Claudia Sahm, thank you so much for being with us. Claudia Sahm of Sahm Consulting and former Federal Reserve economist. We didn't have a lot of time to go into Fed independence and why a lot of people say it is the preeminent concern. But a lot of people say that that is really important. And if Congress doesn't act, the Fed has to counteract inflation and make that their number one mandate.
Yeah, but Claudia is not calling for recession, right? So, I mean, why should the Fed go in and provide support? Why should they pump the brakes? Why should they stop tightening rates if inflation is still an issue? I guess that is the question. Will inflation still be an issue looking out 1, 2, 3 months into the future?
Right, and a lot of people think that it's not going to be the case. I do wonder, though, as you talk about Congress, right? This is sort of my third rail. I'm going to be honest. Hold on a second. Taking out my soapbox, putting it down. I mean, the big failure here is that Congress did not pass certain bills, and that a lot of their power, a lot of the sort of policy making was relinquished to a Federal Reserve with these stopgap knee-jerk reactions with a hammer. Yeah. And that's been basically what got us into this situation to begin with in terms of an unsustainable monetary policy with a very uncomfortable kind of reality on the flip side.
Yeah, lack of fiscal stimulus. And the same thing we're seeing in Europe and the UK. So it's nothing new. But again, I think it's not the Fed's mandate to do that. Whatever the Fed's mandate may be. Yeah. Whoever they are.
Exactly.
Whoever they are.
Exactly. Let's see who they are as they give us a lot of speeches next week. And we'll hear from all of them. And we'll be parsing through it. It'll be exciting. Coming up, we're going to be parsing through the retail results. I'm so pleased that Joe Feldman will be joining us, Senior Research Analyst and Assistant Director of Research over at Telsey from New York. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Shoppers may have a little more elbow room this Black Friday as inflation weighs on their budgets. And those who are willing to spend are looking for bargains and turning to less expensive stores. Consumers will also be dipping into their savings and relying more on buy now, pay later services. European diplomats haven't been able to resolve their differences over a price cap on Russian oil. Poland has rejected the EU's proposed price of $65 per barrel, seeing it as too soft on Moscow. Greece, a major player in the oil shipping industry, doesn't want it to go below 70. Talks may resume today. For the first time ever, China's daily COVID infections have gone above 30,000. Officials are struggling to contain outbreaks that have led to restrictions in some of China's largest cities. The government wants to shift away from citywide lockdowns that have hurt the economy, but some officials are again reverting back to the COVID-0 policies. A new report predicts the world economy will be as weak next year as it was in 2009 after the financial crisis. The study comes from the Institute of International Finance. Now, it forecasts that global growth will slow to 1.2% in 2023. That's largely because the conflict in Ukraine risks becoming a, quote, forever war. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
We're in the early stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
When I started, I had no idea it was going to turn into this. It's a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't wanna minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
This idea that inflation comes down, and will it finally come down in 2023? Inflation was very hard to forecast in 2022. We struggled with forecasting inflation. The Fed struggled with it. A lot of forecasters struggled with it. I think there are a lot of good reasons why inflation comes down in 2023.
Perhaps that is what we're seeing right now, certainly with all the discounts that we're seeing starting to percolate across the retail universe. Andrew Sheets there, Chief Cross-Asset Strategist at Morgan Stanley. Lisa Bromwood's here with Damian Sassower, and this really has been the theme, the cuts. And I keep wondering, are we witnessing the end of the post-Thanksgiving 4 a.m. mob in shopping malls?
Well, I mean, look, I don't think so. I mean, I maybe in the New York tri-state area for sure. But look, I mean, let's be clear. We had a travesty earlier this week in Virginia. I wonder if that's weighing on the minds and souls of people today. Are they, willing to run out to a Walmart, and get in line with, that kind of hanging over people's head? Probably not.
Yeah, well, let's see what's going on as we try to go on the ground. And Joe Feldman in his car going from store to store, senior research analyst and assistant director of research over at Telsey. Joe, where are you right now? What are you seeing on the ground?
Yeah, so I'm in Westchester, New York, up in the near White Plains, and was just going through a Best Buy. And so far this morning, it's fairly quiet out there. I don't think there's this massive rush to get in the store to grab a doorbuster.
Well, how much is this? How much is this, Joe, that we're just basically seeing the end of this? You get in at 4 a.m. and you get the goods, and that's, see people line up, that's over because of the online channels, because of the other areas of distribution.
Yeah, I think that's absolutely right, Lisa, that you are seeing maybe the end of that early morning rush, that need to get in for a doorbuster. Just talking to some associates in one of the stores that I visited, and they were saying, yeah, there was no major rush. The prices are basically the same that you could have had all this past week online, or even walking into the store earlier this week. So I think that impetus or that push to get you in has maybe waned. But I'm very curious to see how traffic is this afternoon, because I do think that people will come out. They want to get social, and we haven't had a real true Black Friday in a couple of years.
Joe, you're 15 minutes from my home in Rybrook, New York, there on Central Ave in White Plains. How indicative, how representative is that Best Buy on Central Ave of, what's going on across the nation?
I actually think it's fairly representative. I mean, look, it's a nice, solid community, upper middle class community around here. People that are looking to buy, and it's a very good retail area here in Westchester. And I do find that it has been fairly indicative. When I speak to the people on my team who live all around the tri-state area, we have some around the country in other cities. And we emailed this morning, and everybody's kind of saying the same thing. It's fairly quiet so far.
So, Joe, is it going to be? Is it going to be electronics? Is it going to be big goods? Is it going to be durables? I mean, where do we see a lot of the sales? Where do we see a lot of the deals? Where do we see a lot of the promotions taking place here?
Yeah, I think we're going to see a lot of promotions. Certainly in electronics, we are seeing that. TVs, headphones, and other giftable items. I think we're going to see. Special occasion wear has been hot lately, and I think that will continue. We've seen beauty, even jewelry has been decent. I think people want to feel good and buy some things for themselves. That's areas where we may see some interest. Toys are always a big driver for the holiday season, but I think it's going to be much more focused on value and the value you can get in a gift for members of your family or some friends.
Value means it's discounted, right, Joe? I mean, this is basically what we're looking at, are pretty steep discounts at a time when there are huge inventories at a number of stores, particularly those that overstocked. I'm thinking of Target. I'm thinking of a host of others, not necessarily Walmart, not necessarily Macy's. How much are you seeing the optimism in the stock market outweigh what you're seeing on the ground with all of the discounts that retailers are having to offer, plus the fact that they're trying to remain fully staffed and not lose people that they might not be able to rehire later?
Yeah, I think there's a lot going on in the retail market right now. There is heavy inventory. There's a need to discount. What we've noticed is that the discounts are not that steep in the sense that 30 to 50 off is fairly common this time of year. And that's what we're seeing. We're not seeing these very broad, deep, 40 to 60%, 50 to 60% discounts. The retailers are definitely facing cost pressures, and they're spending what they need to keep the labor force satisfied. And I think that we're going to continue to see that. We continue to hear that from a lot of others. The big question everybody has is really heading into next year, how much pressure we're going to see on the consumer. Will we tip into a mild recession or a recession at all? And as long as the labor market is in pretty good shape, which it is right now, we're hopeful that things won't be so bad next year, and that will hold up some spending levels. And then, there is some room for optimism, certainly as you get deeper into 2023 when you face easier comparisons.
Joe, you're talking about overall general numbers. How much are you starting to see a bifurcation of stores that cater to the lower ends do worse, and those that still cater to the luxury end still going strong?
Yeah, the bifurcation is very clear out here right now, where you are seeing, the more affluent consumer continuing to spend, and those stores that cater to them are doing fairly well. At the other end of it, there's a lot of focus on value. There's a lot of focus on food and consumables and basics, which is why companies like Walmart and the dollar stores and even Target, are doing very well on the basic side of things. It's really the discretionary side at the low end has been the big pressure point. And that's where you could see some continued pressure this holiday season and into next year.
Joe Feldman of Chelsea, thank you so much. Joe Feldman, you'll be joining us throughout the morning. Happy driving around to check it all out. Damien, I do wonder how much real estate falls into this. And I say this because if you don't own your home, you're dealing with rents that are sky high. And if you do own your home, if you're just buying now, you don't have anything left because the mortgage rate's not going to do it. But I wonder how much that's going to really underpin a lot of what happens with the consumer next year.
No, home affordability is at its lowest in 40 years, but I just want to take you back. I mean, I'm looking for a Weber Genesis E435 with the side burner. And the reason I forgot to ask Joe for a quote on that is because Tom likes his red meat here, but they have the side burner. And, you could cook the pescatore, the veggies for John on the side burner because, he doesn't like to mix. So I need to get a quote on that. I should have asked Joe. We have him back on later. I'll ask him that.
I'm glad that you're using him as your personal shop because as soon as that basically what you're going to do.
I need to know if my wife needs to get out of bed and get online right now. No, I'm just joking, honey.
Up and you're like, hi, it's okay, I'm coming home later and it'll be all good. I am wondering though, are you doing shopping this year on Black Friday? Did you ever do the
For the man who has everything, what would I need to shop for?
For someone who's just amazing.
I'm
perfect.
just, fabulous out there on a Friday morning.
Have you ever done the waking up at 4 a.m. to do the shopping?
No, I've never done it. I've never gotten up early to shop in my life, ever. But I'm sure my wife has, and we'll ask her when we get her on the line at Best Buy.
One thing that I found really interesting about the earnings season is that the online sales have actually disappointed.
Yeah.
It's because people, exactly what Joe Feldman was just talking about, people want to go out there. They want to have the experience of shopping and socializing, but maybe not at 4 a.m.
right.
I can't really blame them.
In the cold.
Yeah, exactly. But not, of course, for Kriti Gupta, who is perfectly toasty and warm. Right now, we're looking at markets quiescent here on a day of holidays in the United States, up 0.1%, 4,037. And those yields, I just can't get over how much they've come down. Coming up, we've got Luke Kawa of UBS Asset Management. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. We had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Expecting a mild recession, just slightly more likely than a soft landing.
We're pretty confident that the peak isn't too far off in the US, despite the fact that officials still sounding hawkish.
The Fed will likely, do 50 to 75 in December.
The Fed will be early to pause. We think the last Fed hike is in January.
What happens between now and next spring, that path is highly uncertain.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It's all about the consumer, and evidently the consumer is a little bit sleepy. From New York City, for our audience worldwide, good morning. This is Bloomberg Surveillance on Bloomberg Television, Bloomberg Radio. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Tom and John are off suspiciously ahead of the 2 p.m. World Cup game. Damian Sassow are very much in. I am so glad that you are here. Not only are you expert in all things fixed income, but you can actually speak intelligibly about football, about the World Cup, and I have officially been shadow banned.
Well, no, I mean, look, we need to see whether or not Reyna sees the field. He's got to get on the pitch for the U.S. I mean, Harry Kane, he was injured. We need to see if Harry Kane, is Harry Kane today. But look, I'm optimistic that the U.S. is going to, show up today and hopefully keep it competitive because, England looked awesome.
Oh, so you think that they're?
I think England's a favorite. Yeah, they're one of the better teams.
Okay, well, so you're trying to get in good with John. I am wondering. So I did say that this is a sleepy consumer, and it feels like that's the tone that we're hearing, whether it's from Kriti Gupta, whether it's from Joe Feldman, that there isn't this rush to the stores, and it does sort of remain a question, as Claudia Sam was just talking about. Are we going to see that resilience sustained at a time when a lot of people are seeing tea leaves?
And how that kind of flows through to earnings. And it's good that we have Gina Martin-Adams coming on to guide us through that, because I think the consumer discretionary sector is the one that a lot of people are talking about in 2023 as being the outperformer.
Well, and this is because they see the next leg of the cycle coming back next year, and that possibly everything's going to get good. And it's sort of like we're fast forwarding through the bad that's going to inevitably happen, and then getting right to the good and saying, okay, so the Fed will do its thing, and then it's undoing everything that the Fed is trying to signal to markets. How do you square that?
I don't know. I guess you sell energy, right? You sell ExxonMobil. No, I'm kidding. No, look, I think you just have to kind of look. I personally don't think equities are going to have a great year, at least in the first half of 2023. But I think it's shaping up very similar to what it did into 2022. It's going to be a tale of two halves, and so we'll see whether or not we actually do slide into recession in the U.S. My thinking is earnings are going to come off, but not as much as people expect.
Do you think that the narrative that currently is the consensus will last for more than a month?
No.
I mean, I'm asking that because right now the consensus is bonds will rally next year. The dollar will weaken.
Equities will weaken.
Equity will
Europe's
weaken
in
in the first half. The second half, they're going to do well. China's stocks and bonds are going to do really
markets.
well. Yeah, go with emerging markets. Right. This is the consensus. You think it's going to last a month?
I don't. I don't think. I think, look, the one thing that is assured for me is that realized vol is going to be way higher than what markets are pricing in. We've seen that. We've seen the convexity selling does not work. So I believe we're going to see more of the same. I think it's going to be very jumpy. It's going to be very volatile, at least through the first few months of 2023, simply because there is no real paradigm to kind of latch onto. You're transitioning from inflation to growth concerns, and the market's going to have some difficulty with that.
So I was writing down, sort of the year ahead encapsulated by Thanksgiving conversations, because it seems like every year it sort of is a turning point. The inflection point last year was Bitcoin was the rage, and why haven't you invested in Bitcoin this year? Perhaps it's that in reverse. I was thinking about inflation. How much are people talking about how expensive their turkeys are? I know. Do you want to weigh in on that?
Well, I mean,
he doesn't want to end up with a bad situation at home.
Right, exactly. No, I'll tell you this about crypto. You make a good point.
You're going to dodge the turkey
One
question.
of my niece, somebody she's dating actually went to middle school with Sam Bankman-Fried in San Francisco, and he was like, a smart guy, went to Jane Street and all that stuff, but it's just amazing that this kid had convinced, the Sequoia Capitals, the most, sophisticated investors in the world to invest all that money in him. It's just unbelievable, the unwind it reeks of Madoff to me.
Well, that's a lot of people are talking about, and Enron and a whole host of other fraudulent
Unregulated
situations.
offshore jurisdictions, shell
But
companies, the whole 9 yards.
When I got home to my parents last night for Thanksgiving with the family, my dad comes up to me and he says, "What else don't we know? What other improprieties could we be funneling our money into without knowing it?" And I wonder whether that is getting into some of the mood or if it's just my paranoid situation at home. Well, let's talk about that coming up. Coming up, we are going to have incredible conversations this morning. Christian Muller-Glissman of Goldman Sachs at 7:45 a.m., Jordan Rochester at 8 a.m. of Nomura, and David Page of AXA Investment Managers at 8:30 a.m. Right now, the one, the only, fresh from shopping online, Gina Martin-Adams, Chief Equity Strategist for Bloomberg Intelligence. Gina, how closely are you watching this Black Friday?
You know, I'm watching it closely for the sense of the consumer sector's outlook. It's not as important from a broader sentiment perspective, I think, as many people believe, as shopping trends have certainly changed, as online sales have become more important, as expectations, frankly, for this year are at rock bottom levels. So I'm watching it. It matters a lot for the consumer sectors, as you were just speaking to the outlook. The consumer sectors are expected to bounce back into 2023. Consumer discretionary is expected to be the fastest grower among sectors in the S&P 500 in terms of EPS trends. That is not because there is an expectation for recovery in sales, though, and I think that this is an important point to make. Revenue growth is actually expected to slow into 2023 for consumer discretionary. It's more about margins. It's about inflation pressures easing and some of those inventories finally getting cleared off the shelves. So what we want to watch for with Black Friday and in the weeks leading up to the Christmas holiday is really, are the inventories getting cleared out? Can the companies sort of right-size those inventories levels relative to a suppressed level of sales expectations? Because that is going to be consequential to creating that margin low and that turnaround in EPS growth into next year.
Gina, the problem that I have with that thesis is that you're seeing companies reluctant to lay off workers. They want to keep their staffs full, and they need to pay people at a time when everyone is very aware of inflation. So at what point do you see the deal hunting on one side? You see fully staffed stores that can't necessarily exercise the layoff lever. How much does that eat into margins more than people are expecting?
It's definitely a risk, Lisa. I'd say it's less of a risk than it has been in past cycles because of the dynamics of this cycle have been so unique. We've only had a 2-year cycle, right? And so companies have not been able to lever up in terms of their labor force to the degree that they usually would throughout an economic cycle. They're not as bloated as they normally are. Recall in 2020, it was all about online sales, retaining growth. 2021 was a mass reversal of that. 2022 has been about inflation. There's been a lot of volatility this cycle, so companies have actually been relatively cautious in terms of their overall planning. They got caught in 2022 with too much inventory, and that's why we lean on this so much. The broader employment dynamic is consequential. It's especially consequential for retailers who have very high levels of employment per share of sales in comparison to many of the other segments of the index. So it definitely is something that you want to watch as a general issue for these companies. But you can have such a magnificent shift in margin just due to inventory management that the companies can mask over a lot of inherent cost due to employment conditions with that shift in inventory and the deceleration in inflation. You've got to consider the fact that we're coming off of multi-decade levels of inflation in price. Companies have been able to pass on some of that inflation. If they can retain those higher prices in an environment where their input costs are going to go lower, that's also a pretty big boost to margin into 2023. So it's an issue. I wouldn't argue that it's the overall issue. It's something we want to watch for sure, those employment conditions, but I think that it can be overcome by other components of the income statement.
Hi, Gina. Good morning. So listen, dollar strength has been the feature of the current beta regime. You know, if Kitchukes is right, if the dollar is peaking, you know, what does that mean for U.S. equity earnings going forward?
Yeah, it's a very much sector by sector, industry by industry question, the dollar. For retailers, for example, they get very little share of their sales overseas. They import a lot of product. Dollar strength has actually been a very big plus. For the retail sector, it's helped with the inflationary pressures that have emerged over the last year. On the other end of the spectrum, you've got multinationals in the industrial space as well as in the technology space that have had a pretty tremendous headwind emerge from the dollar over the course of 2022. That could reverse into 2023. In general, frankly, I think that currency is overstated as a component of overall earnings conditions, particularly in an environment where you have such rapid shift in economic conditions globally. A slowdown in Europe could emerge over the course of 2023. Obviously, slower growth in Europe will overwhelm anything that happens with the currency, most likely. So I think that economic conditions are first. You definitely want to watch those growth conditions overseas for the multinational sales lines. But behind that, I do think that the currency can matter.
Gina Martin-Adams of Bloomberg Intelligence, thank you so much for being with us, and good luck with all of the incredible amounts of shopping that we had just heard that you're going to be doing. I'm looking right now, so I'm going to defer to you because as much as I want to offer some expertise. So Iran. 1-2-0 versus Wales, and evidently, which is sort of shocking, especially considering Saudi Arabia's and they got smoked, and Saudi Arabia's win. I mean, it's just sort of this interesting World Cup of underdogs in a way.
Yeah, Japan. I mean, everything. You know, it's kind of unbelievable. So, I mean, Saudi Arabia. I mean, these underdogs it's pretty unbelievable. I mean, my brackets are getting crushed here, by the way.
I think a lot of people's are.
I mean, you know, I never knew that in a bracket you could pick a draw. Like I thought it was win or loss, but draw is an option there. I mean, that just makes it really, really challenging for me. I didn't like it.
I'm so sorry.
Like a trinomial. It's not a binomial tree. It's like a trinomial.
You're gonna protest. Last minute injury time goals. That's what fueled the win. Did you see the Japanese team? How they left their locker room as they left. To me, I thought this was amazing.
Were you seeing the fans in the stands who were cleaning up afterwards? Did you see that?
The fans in the stands
Unbelievable.
That were cleaning up.
So classy.
And then the actual team that ordered everything. They made it immaculate.
Yeah.
And it was this statement of respect, and this is how we treat our things. And
much respect.
I completely respect that.
Respect with a 3, R3SPECT.
How old are your
Derek
kids
Jeter
again?
fans. Derek Jeter fans.
Wow, we're having a situation here. Damian Sassower and I are going to parse through it. Coming up at 8 a.m., we have a conversation with Jordan Rochester, G10 FX strategist at Nomura, to talk about, what was it again? It's the ideal place in a smile. I feel like
dollar smile.
Yeah, the dollar smile. Honestly, I feel like that should be a song, a band. The ideal place. Okay, I'm going to stop. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Retailers in the U.S. are bracing for a slower than normal Black Friday. High inflation and sagging consumer sentiment are hurting Americans' demand for material goods. According to S&P Global Market Intelligence, seasonal sales are likely to fall 1.2% after adjusting for inflation. That would be the first decline since 2009. In China, the central bank has taken another step to boost the economy. It's cut the amount of cash that banks must hold in reserve for the second time this year. The adjustment to the reserve requirement ratio takes effect December 5th. It will inject $70 billion of liquidity into the Chinese economy. In Ukraine, half of the capital's residents are still without power following a barrage of Russian missiles. The mayor of Kyiv warns that limits on electricity will continue. President Volodymyr Zelensky says the situation with power is difficult across the whole country. Now, Elon Musk says Twitter will relaunch its verified service next Friday. Earlier, Twitter suspended its $8 subscription program to fight a growing problem of users impersonating major brands. Twitter Verified is Musk's attempt to distinguish between different classes of users and also to drum up some much-needed revenue. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Top names in climate change are on Bloomberg.
Building out local wind, local solar, hydrogen, these are solutions to not just climate issues, but geopolitical issues.
We are in a position by 2030 to have 80% of all electricity generated by wind.
Renewables are the safest, the cleanest, and the cheapest form of energy today, especially for countries such as Greece.
Nobody covers climate change like Bloomberg, your global business authority.
We're in the early stages of a sustainability revolution that has the magnitude of the industrial revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
Remember, the ECB's not been hiking rates for long. There's going to be a lag before the effects of the tightening of financial conditions start to come through. I think we are still heading into a recession. There's less evidence in the Eurozone of a let-up in price pressures.
That was Jennifer McEwen, Chief Global Economist at Capital Economics, as we take a look into a difficult winter over in Europe, even though we do have perhaps stockpiles that are more than expected. Joining us now, Damien, I want to get right to him. Damien Sasser alongside me today. John and Tom are off. We have been trying with World Cup. You've been doing a great job trying to uphold it. I have utterly failed, although I will say I did see the Richarlison kick, and that was absolutely knock your socks off. Wonderful to see and just sort of shocking. Maria Tadeo, of course, is covering this in a much more sophisticated stance over in Brussels. Our Bloomberg European correspondent, and now our football correspondent from Brussels. Before we get into the real stuff, what have you been watching? What do you sort of, I mean, other than go Spain, okay, I get it. But like, what's been the takeaway for you?
Look, I mean, the real takeaway for me is, of course, I'm biased. I'm Spanish, but 7-0 in initial match that they did 2 days ago. I'm sorry, but I'm still shaken from that. I think the real takeaway is that we have a very good team, very young. They've had the time to bond. The coach, I think he really is in the right mental space. And I don't want to jinx it, but I think Spain is going to go very far in this competition. Now, I don't want to talk about other teams because, let's just say I want to be diplomatic diplomatic, but the game I'm looking forward to, of course, is Sunday, Germany versus Spain. And I have a prediction. Right. I don't want to jinx it, but that's another game that I'm going to keep an eye on.
Okay, literally, we just basically, you've been paid off to come on here as Madrid's blog. Okay, Maria, you haven't. Full disclosure, I do want to get to some of the serious stuff. You have an interview coming up with the European Commission of Trade, Valdis Dombrovskis, and this is a really fraught moment for trade between the U.S. and Europe. How is the Inflation Reduction Act causing a real existential crisis throughout the EU?
Look, I love the way you framed it. Could this be an existential question, an existential crisis for Made in Europe? And I think that's essentially what officials and diplomats are thinking and debating behind the scenes. Many do feel at this point they've been hit by a perfect storm. You have the energy crisis. Of course, that means that energy costs are going up across Europe. Then you have the United States coming in strongly with this Inflation Reduction Act, which for some companies, even European companies, could be an incentive to relocate because it's better to do business in the United States. And on top of that, you have China with an aggressive industrial policy. For many European governments, they really do feel they're getting a bad deal in every possible way. And the space they have to compete and stay attractive is becoming narrower and narrower. So this is definitely a big issue on this side of the world.
Maria, talk to us about these proposed gas and oil caps, on Russian energy. I mean, Poland sees $65 is too low. I think Greece sees $70 is too high. Is there any way that we can come to terms across these different countries with these different needs? Is there a way that we can have different caps for different countries? Just how fluid can we get?
Look, where to begin? All I can say is I was here yesterday in this same exact spot for 12 hours waiting for a cab, and in the end we went home empty-handed, the same way we started the morning. I do want to clarify, especially for an international audience, in Brussels there's two debates going on. One is on the gas cap. That's of course the TTF benchmark. The European Commission has decided they would trigger a cap, so a limit up at 275 euros megawatt hour for 2 weeks. For some countries, however, the criteria is just so high and so extreme that it will never be triggered. They want to see that threshold being changed. Now, when you look at the oil cap for Russia, the debate is around, again, the price point. $65 a barrel was floated. Others suggested 70. The problem is the countries in Europe that are hawkish on Russia, like the Poles, the Baltics, they say it's $65 a barrel. You're still too generous in Russia. And by the way, there's also the overall criticism here from some in the market that suggests these caps are not going to make any difference, and if anything, they could lead to serious issues on the supply side of things in a market that's very tight and there's fierce competition.
Maria, on a more serious note, I mean, is Gavi really 18 years old? Is that right? I mean, he's got to be at least 19 years old. I mean, the kid is playing out of his mind for Spain.
Look, I have to be careful here because this guy's way too young for me. But of course, this is the crush of everyone in Spain because he did such an incredible game. Also, by the way, the entire team is very young. But yes, he was MVP in that game, one of the youngest strikers to score in a World Cup match. You have to go back to the times of Pelé to see that kind of performance. So honestly, I mean, I'm not going to lie. I'm very pumped up about my team this year.
Animation there. Maria Tadeo, thank you so much. Damon, you're just trying to wind her up, aren't you?
I mean, the fact that she just said she has a crush on Gavi, welcome to the club, so do I.
Well,
he's awesome.
I will just say, though, in a more serious note, what she was talking about there before you took it to her crush, and I guess the world's crush, was this question that's very serious in her conversation with Valdis Dombrovskis today about how Europe deals with the Inflation Reduction Act in the U.S., which could draw an incredible amount of investment to the U.S. It subsidizes certain types of tech jobs, certain types of renewable energy jobs. What does that do if it really creates an even greater gravitational force away from a European region already having a lot of issues?
$437 billion bill, it's going to create trade tension. That's what it's going to do between the U.S. and the Eurozone, and that's something we can ill afford, I think, at this stage in the game. So hopefully, the two governments can work together. We can come to some sort of terms about exactly what this means for the Eurozone. But my goodness, the overhang is there, and I think, as consensus rightly points out, the risk of a recession in Europe is real.
Although, not to be controversial, but Europe also kind of got itself into a tight spot that is affecting the U.S. as well. I mean, given the fact that it was relying on Russia to such a degree, and Germany in particular.
Olaf Scholz.
And there is a real challenge now from a political relations standpoint. How do you deal with the fact that, yeah, the world is dealing with an energy crisis that in large part stemmed from a perhaps faulty relationship and sort of drawing something up that was sort of a little bit short-sighted.
Well, Lisa, I mean, we can't look backwards. How did we get here? We can't look at what Olaf Scholz and previous administrations did in Germany. We could look at Trump here in the U.S. also. Everybody makes mistakes. It's how do we take things going forward? And I like to believe that, look, the Eurozone is going to work together. They're going to get the caps in order. They're going to work with the U.S., try to see what this Inflation Reduction Act means. My thinking is I'm pretty positive. I'm a glasses half full guy. I think that, you know, things are going to get worked out. It takes a long time to offshore real sectors and businesses in climate and other areas.
But I do wonder where the tensions really start to accelerate, particularly with China, right? Because so Olaf Scholz is now dealing with, okay, how do we remove from Russia? But, oh yeah, we just got back from a trip to China and we brought VW's CEO, we brought other industrial CEOs. And now there was a story today about how VW is facing incredible amounts of competition in China from local companies that are making the same types of products and are going to get sort of emphasized. So at what point do you end up with further tensions? Okay, we can't look backwards, although we can, but how does that inform what we're doing for the years ahead?
I mean, look, your guess is as good as mine. I mean, you make a good point, though, about Geely and some of the China auto manufacturers and how they're kind of crimping in here on VW and some of the other big auto manufacturers out of Europe. Look, you know, your guess is as good as mine. I think it's going to be good for all parties. It's fiscal stimulus in whatever shape or form you mean.
I'm not arguing for one way or another. It's just it's a complicated moment, certainly, for both sides of the Atlantic. Coming up, Luke Hawa, Director of Investment Solutions at UBS Asset Management, who also can speak better about the World Cup than I can, because so can pretty much everyone. From New York, this is Bloomberg.
watching and says, I want to be Ari Emanuel when I grow up, what should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg Surveillance. Welcome back. Lisa Bromwitz and Damian Sassower. John Tom are both off, and perhaps they are going and having some hot toddies as they try to prepare for the World Cup game. In the markets, it isn't exactly a riveting day of trading that is shortened ahead of that 2 p.m. close. We are looking at toggles between gains and losses. The S&P up about 0.2%, the NASDAQ marginally lower, basically nothing happening. People are all home in their Turkey-based stupors. We're also looking at a bit of dollar strength. I mean, honestly, I can't even call it that. It's basically flat, 103.92 on the euro versus the dollar. And yields, I mean, honestly, to me, Damian, this is the story of the week. We have seen yields, for the most part, come down pretty dramatically, despite hawkish rhetoric, despite the fact that we've seen resilience in the economy. It's sort of like the market is saying, okay, we challenge you, Fed. We think we're right. You're wrong.
Yeah, no, I mean, for me, I'm still struggling to find that Goldilocks scenario for asset prices as we turn the page to 2023. But more importantly, what's the pain trade? Is it rates going higher, or is it rates crashing and coming much lower? I mean, that is, something that we're struggling with here.
But it doesn't seem like that's already almost the base case, that people, it wouldn't be the pain trade anymore because so many people have been going into duration.
Long duration, yeah.
I mean, at what point does this really create a tension for the Fed? They've got to push back. They say, we don't want rates to keep going down because that eases financial conditions. This has been a perennial story where perhaps they're going to be being a little more vocal.
It's funny that you say the Fed, because I would make a difference between Brainerd and Powell at this point in time. So it's not the Fed.
That's right. It's Lael Brainerd who has perhaps a bit more of a dovish approach.
Correct.
With a bit more hawkish Jay Powell. Right now, we can speak to someone who also probably spent too much in their turkey, although we still have yet to get the actual cost out of Damian Sassower, who is reluctant to say. Luke Kawa, Director of Investment Solutions at UBS Asset Management, can tell us not only what he made, but what he made for his dog. Luke Kawa, turkey for a dog? Really?
Say, two years ago, the dog was in the crate. This year, the dog and its friends were out and get their own turkey. So inflation, both in the prices and how much I'm buying now.
Gonna have our own dog table. Luke Kawa, truly remarkable, and I always look forward to the posts of your different culinary adventures on Instagram and on Twitter. So right now, as you look out, we were starting on rates, and we were talking about this incredible move lower and how that creates a conundrum for the Federal Reserve that wants to have tighter financial conditions. Do you buy into how much yields have come in and this belief that they will continue to do so despite this real tension with central banks?
So a lot of the story with regards to the Fed and with regard to short-term interest rate pricing has been, okay, so when are we going to get the recession? How bad is it going to be? And really the story of the year has been really pushing back the timing more and more of that recession start date. So for a long time, the high-yielding contract and the euro-dollar SOFR futures curve was December. So people effectively saying rates are going to peak, around this time of the year. Now that's been pushed back more, but you still have a lot of hikes priced into the back, say between June of next year and the year thereafter. They're still about pricing for over 100 basis points of cuts. So what the economy has and what we think the pain trade might be heading into 2023 is that just there's a lot of theta decay, so to speak, in those positions, that as the economy is resilient, people just have to keep pushing back the timing of whatever recession or actual Fed pivot you get, that the real pivot is happening underneath in the real economy with some relief in gas prices, some kind of immaculate disinflation starting just a bit. And that's actually providing a bit of a real income boost that's getting us to a time where a lot of 2022's headwinds are going to turn into some mild tailwinds for 2023 around the end of the first quarter.
So, Luke, I forget what the house view at UBS is for the terminal funds rate. Let's just say it's 5%, right? I mean, do you see risk skewed more to the upside or downside to that level?
I think we see risk skewed as more to the upside from that level, and it's just kind of simply a timing call you have to make at this time in terms of how strong can the U.S. labor market be for how long. First, I think zoom out and look at the global picture. The U.S. has probably faced fewer headwinds than probably any other advanced economy this year, and yet it's the global labor market that's really holding up still. So you have to make the call. Do you think the U.S. labor market is really going to deteriorate meaningfully in the next 3, 4, 5 months? If not, then you're getting closer to a time where Europe's industrial base is going to be in a much better position for production than they are now. And China, although we certainly don't expect any kind of straight line in terms of reopening, and I think the present recent experience has been kind of shed light on why that should be the case. But you do expect things, the direction of travel, to be better rather than worse. So if the U.S. labor market doesn't really crack in this kind of upcoming period, and there's not very strong reason to think it should, then we get to a point where some of the kind of endogenous strength in the labor market that's keeping a more persistent force under inflation in the eyes of the Fed is still going to be there. The conditions for that are still going to be in place 3 to 4 to 5 months out from here.
So, Luke, I think that's absolutely key. I mean, that potential for U.S. exceptionalism, for economic resilience. But what does that mean for asset prices in the year ahead?
So one of our views is that kind of this more resilient view on the economy, this idea that, people are going to have to become more optimistic by becoming less pessimistic. That's not necessarily a great news story for stock prices. And that's just because the valuations we're trading at and the extent to which government bonds at the longer end have come in a bit lately, that pressure is still going to, increase further from here. The idea that just, we've gotten a bit of valuation relief lately, and we probably have to give it back if the economic view is the same. So it's an environment where earnings probably do a little bit better than expected, but the kind of U.S. 10-year yield is back closer to the highs of where it was for much of this year. So, in that environment, risk assets at the headline level probably don't make too much progress. Where we do see kind of room for more progress in that environment is value cyclicals relative to defensives in particular, relative to kind of more high growth tech stocks, and see a lot of scope for continued gains there. And this is just when you're kind of pricing in the degree of pessimism you see now for 2023, then anything that's better than that looks like a very good news story on the cyclical front.
So cyclicals, this has been the real challenge for us to get our head around today, especially on Black Friday, because Luke, we've been talking about how there really aren't that many people out there yet. Maybe they'll head to the stores later. And we're hearing about discounting pretty significantly. We're hearing about waning consumer sentiment. So why, if we're heading into a soft downturn or sort of a shallow downturn, would consumer cyclicals do the best, given that they've already rallied tremendously and given that the consumer is perhaps losing steam? I mean, some people don't believe in that, but where does that storyline kind of come together?
So while I would kind of agree on the recent price action, I'd push back a little bit and just say, think of how much kind of pent up demand that was pulled forward in the tech space that has yet to normalize versus kind of the recent rally in consumer cyclicals, the valuations they're still trading at. I don't think that we've squeezed all the juice from this bottle left, so to speak, at all, especially in an environment in which the economy continues to hold up. I think that would be a more main challenge. It's just on what's priced in, and we don't see as priced in, even after kind of some of the recent rallying consumer cyclicals. We don't see an environment that says people are still very optimistic in the ability of the U.S. and the world writ large to avoid a kind of broad-based downturn. So if the frame is a shallow downturn or mild downturn, we would just say open yourself up to the possibility more and more that no downturn is something that we have to fully price in and something that is not yet fully in the price.
Luke, I mean, many, myself included, believe we're in phase one of rate normalization here in the U.S. I mean, we're seeing a better bid for receivers. We're seeing the vol related to higher yields falling. Talk to me about U.S. Treasuries. Do they look attractive to you here at current levels?
So right now, our view on Treasuries is that a neutral position is kind of best, and this is because of the optimism we talk about on the global economy. That obviously points to higher terminal. I've already discussed kind of risks skewed to the upside from a 5% terminal. However, on the other hand, we can't ignore the potency of the inflation peaking narrative and the growth slowing narratives. It's very rare to have kind of a situation where you'd say, well, growth is slowing and inflation slowing. Why wouldn't you want to be long duration? Well, the answer here is just that underlying resilience of the labor market. So if you're kind of doing your Fed checklists at what gets the Fed from slowing the pace of hiking to actually pausing completely, it's a series of readings that inflation is heading lower. It's breadth in those readings, so not just give back in goods prices, but rather something that spreads a little more to services. And then it's also corroboration via the labor market. So those dynamics are just something that we think are going to take time to develop. And as they take time to develop, that means the cuts that have been pushed out further down the road, they start to get actually priced out a little bit and pushed down further. And that's something that we think, in concert with the potential for the terminal rate to go kind of back to the highs of where it's been this year, is something that leads us to a bit of a more neutral stance on duration here.
Luke, just real quick here. So you think that the Fed could raise rates to 5%, hold it there all of next year, and we could still avoid recession next year?
One thing we're really trying to do, especially after 2022 and all the surprises the past 24 months, is to consciously avoid having that 1 year forecast. We want to have really good 3 to 6 months outlooks and work from there and reevaluate from there.
All right, Luke Kawa, thank you so much.
Phenomenal
of
answer.
UBS Asset Management.
What a great
thank
answer.
you.
He's
that was
so
great.
good.
That was very smooth.
He's very smooth.
6 to 8 months. Don't talk to me until after that.
Lisa, I'm curious. What does peak hawkishness mean to you? Because I hear people talking about peak hawkishness. What does that mean? Does that mean the Fed just moving from 75 bip increments to 50 bip increments? Does that mean a pause out? Right? I mean, everyone's like peak hawkish. I don't understand.
That's exactly how they sound when they say it. No, this is actually something people are talking about. It's also, what do they mean with pivot, right? I mean, does pivot mean that they go down a step? Do they the step down? Or is it that they actually start cutting rates? Or is it simply that they hold rates? I've been reading a number of notes that really define it as starting to cut rates is the real pivot point.
Okay.
But
the markets are going to look through that. They're way in anticipation of that by the time they actually cut.
And this is a real tension point. And so you are going to get this pushback that Luke was just talking about that I find, really problematic for the Fed. I don't know. I think you're right, though. What do we call peak hawkishness?
I mean, what does it look like? I mean, how the market's going to interpret it is really the question I'm asking.
To me, peak hawkishness is a peak Fed funds rate that is well above anywhere that it could be, right? That it feels like, you've reached a level, like Jim Bullard's 7% level, that if that became consensus, perhaps we could call that peak hawkishness.
You want something to break. You're looking for
I'm
something to
not
break.
looking for something to break. I'm just
looking for something to
suggesting,
break.
I know, I'm sure you are, because it's a great trading opportunity, but I will tell you.
I broke a piece of Tupperware last night on the floor. Glass everywhere. It was terrible.
Oh, well, we'll discuss that.
Broccoli.
Xavier Sassauer, we're sorry for that. Coming up, Christian Muller-Glissman, Managing Director of Portfolio Strategy at Goldman Sachs. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Shoppers may have a little more elbow room this Black Friday as inflation weighs on their budgets. And those who are willing to spend are looking for bargains and turning to less expensive stores. Consumers will also be dipping into their savings and relying more on buy now, pay later services. Thousands of Amazon warehouse workers in about 40 countries will mark the Black Friday sales day with protests and walkouts. They're demanding better wages and working conditions in a campaign called Make Amazon Pay. Employees in the U.S., U.K., India, Japan, and Australia are among those taking part. Amazon says it takes its role seriously on what it calls these important matters. For the first time ever, China's daily COVID infections have gone above 30,000. Officials are struggling to contain outbreaks that have led to restrictions in some of China's largest cities. The government wants to shift away from citywide lockdowns that have hurt the economy, but some officials are again reverting back to the COVID-0 policies. Adidas is launching an investigation into claims that rapper Ye mistreated designers and other workers at the German sneaker chain. An article in Rolling Stone magazine cites former employees who allege that senior managers turned a blind eye at the inappropriate behavior. Now, Adidas cut ties with the artist formerly known as Kanye West last month after he made a series of anti-Semitic remarks. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Likely that 5.25% gets realized and kept. We think the Fed is really determined to try to avoid a recession. I think it's more talking about the potential of a recession than anything else.
That was John Stoltzfus, Oppenheimer Asset Management Chief Investment Strategist, with a note of optimism among a lot of gloom. Tom Keene, Jonathan Farrow, Lisa Abramovich, Tom and John are both off. Damian Sassower is with me today, and I'm so pleased to say he can give you much better World Cup coverage as well as all things having to do with emerging markets. Right now, I want to go straight to our guest. He is one of the brightest minds on Wall Street, Christian Miller-Glissman, Managing Director of for Portfolio Strategy at Goldman Sachs. And Christian, I want to start in Damian's specialty in the developing world, because overnight the lockdowns in Beijing, the first lockdown in the capital of China, to me is a really significant story that changes potentially the narrative for next year. How do you view that story in light of some of the optimism around China's reopening?
No, you make a great point. I think if you think about outlook for next year, China was one of those bright spots because there's asymmetry. The economy is in its knees for clear reasons, like asset prices are in very bearish kind of territory. So it felt like there is a story that's emerging that can, to some extent, support next year and drive growth acceleration, drive that trough in economic activity. But I think what we're learning, and I think what our economists have been saying as well, it's going to be incredibly bumpy. I think the end game is that China will probably, by second half of next year, accelerate with regards to growth helped by the reopening. But the path to that could be incredibly bumpy. And the real reopening, we always thought would occur kind of around Q2. And as you see those cases go up, you could say that, the risk is definitely that it's being pushed further out.
But Christian, how does this affect, the different parameters, if it reopens, if it doesn't, the bumpiness that you see? Is it bullish if they reopen, if that means incredible demand suddenly coming online for energy and for commodities generally at a time when that's one of the main drivers of disinflation right now?
Yeah, and you highlight one of the big dissonances, like one of the big kind of negative cycles there. I think right now, as you know, oil prices have kind of come down significantly, like curves are in the front end a bit in contango. So I think you're dealing currently with a setup where there's a bit of a buffer, but you're absolutely right. There is definitely a chance of a replay of headline inflation volatility next year, which then feeds a bit into rates and to some extent kind of can drive also spillovers to risky assets. But I think at this juncture, this full reopening, as I mentioned, is to us more of an H2 story. I think in the near term, it seems to be more of a drag on oil than anything. But it does highlight something which you mentioned. I think to me, risk premium in the last month have significantly come down across the board on China assets, but also on global cyclical assets, on China-exposed companies in Europe. And it just feels like there's not that many good growth stories to go on. The market has embraced it very quickly. Partially, that has contributed to a bit of a false start in kind of relief on the growth side, and it could very quickly reverse to some extent if that doesn't prove to be the case.
Well, let's just crystallize that. I mean, a bit of relief. I mean, we saw a 22% increase in the Hang Seng China Enterprises Index since, October, but we're still down 27% year to date. Talk to me. I think investors are realizing, myself included, that you just can't have zero exposure to emerging markets in China, right? So my question for you is, what is the best way to get that China exposure? What is the best way to play the reopening narrative in China?
You make a great point there, because it's been really difficult for international investors from a strategic point of view to get excited about China. And there's a concern with regards to how investors will benefit from China economic growth in the coming years. There's been a concern with regards to, obviously, zero COVID. And at the same time, you have this reopening story. The reopening story, if you follow the kind of template from developed markets, should be very good for domestic, consumer cyclicals, services sectors. And it's not easy to get exposure to that via the headline indices. Our team generally have become quite a bit more constructive. The whole North Asia complex, which they think will be pulled along, so you can diversify to some extent, just being in China with maybe being a bit more in Korea, being a bit more in Taiwan. But in the end, if you really want to kind of go directly exposed to the reopening, you need to go potentially much more on specific sectors, specific stocks, and it becomes much more of an alpha theme. So our strategy team, they've created a basket for that, which clearly for a lot of the asset allocators I speak to, that becomes too specific.
Christian, I could talk South Korea and Taiwan with you all day, but let's shift back to the U.S. here for a minute. I mean, look, there's been a lot of talk, no recession, shallow recession. I think markets are pretty much coming to terms with the fact that growth will indeed be slower next year in the U.S. Meanwhile, inflation, while it is expected to come off, it's going to be above pre-COVID levels, I think, for some time. So in a world of slower growth and inflation, kind of remaining elevated, what fixed income asset classes are best positioned to outperform?
Yeah, I mean, especially after what I mentioned, this risk premium contraction. I mean, you've seen a remarkable tightening in credit spreads, even down in quality. It just tells me that you need to be up in quality into next year. I think generally we feel that next year, you spoke about this earlier. This year, a lot of the fear was about peak hawkishness and very high rates volatility. And I think next year will be more about growth volatility. I think rates volatility will normalize just by extension of central banks slowing the pace of hiking. And that just means that you're shifting a bit towards solvency risk, and you're shifting towards strength of balance sheet. And this year, as you know, you have had very little cash flow risk, very little cash flow shocks. And next year, you would probably see more of those, which means at this juncture, with the type of risk premium you're getting to move up the risk curve, we feel up in quality. Investment grade credit is where we would be. And there's opportunities there to kind of harvest more attractive yield to volatility ratios. So, for example, mortgage-backed securities, they benefit a lot from a decline in rates volatility, is a relatively low risk asset. So we'd rather be in these places until we get a bit more rebuild in risk premium, which we expect could be in the Q1 next year.
Rebuild in risk premium is such a nice way of saying high yield bonds selling off. Christian Muller-Glissman of Goldman Sachs, thank you so much for being with us. I mean, right, that's basically how you build that risk premium. It's price down, yield up, or basically implied widening of those credit spreads.
Well, that's the litmus paper of fixed income, Lisa. No, I'm just kidding. I think the one thing that came out that Christian, and I really would have liked to ask him about, is he equated high grade credit with mortgage backs, and we know what's going on in mortgage backs. And if you look at the coupon stack, I mean, 80% 80% of the MBS universe here in the U.S. is trading at a 4% coupon or less. So really, at this point in the game, is it right to think that mortgage backs offer value? I'm not entirely convinced, but I find that very, very interesting.
Are you convinced that we're going to avoid some sort of significant house price downturn?
Look, I think it's going to be challenging, but I do. I think we're going to manage to avoid it this time. I do.
This is one of the big questions. This was actually a huge topic of discussion at my Thanksgiving dinner, which just tells you how amazing that Thanksgiving dinner was. This real, heated argument over the fate of housing. Coming up, Jordan Rochester, G10 FX strategist at Nomura, will be joining us. This is Bloomberg.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. We started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And frankly, when people leave 23andMe, I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. I want to build out a true consumer-empowered healthcare world, one that is outside of the existing system. And there's no greater force than government.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
inflation was very hard to forecast in 2022. We struggled with forecasting inflation. The Fed struggled with it. A lot of forecasters struggled with it.
In the US, we're seeing much clearer evidence of price pressures easing up.
There's a lot of risks that are still out there.
There's been big dispersion across markets, particularly if you look at rates versus currency.
For investors, you need to exercise patience.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is officially countdown to year end. Welcome back. This is Bloomberg Surveillance on Bloomberg Television, on Bloomberg Radio. Tom Keene, Jonathan Farrow, Lisa Abramowitz, Tom and John, both off today, perhaps just digesting their turkey. Damian Sassower, very much here, I'm so pleased to say, also digesting his turkey, which, okay, let's just have it. How much did it cost?
It was triple digits, mid triple digits.
Mid triple digits for a turkey, so I got you in trouble. I sort of apologize. We are talking about the end of the year and the look forward prognostications, and a lot of people are really betting that inflation will come down very quickly. And it's notable on this Black Friday that we talk about that amid all of the discounts that we hear really are driving a lot of the sales.
Yeah, inflation's a problem, right? But I'll tell you where inflation's not a problem, in places like Turkey and China, which both cut rates overnight. So, I mean, let's be clear, you know, it's very idiosyncratic. It's a word we love to use around here in terms of where inflationary pressures are.
I'm not letting you talk like this. Absolutely not. Okay, because Turkey has an inflation problem. They might not admit it, but cutting rates doesn't mean that they don't have an inflation
disinflationary pressures are evident in China, and I think we're going to see that spill over into, you know, some of the other G10 markets, specifically here in the U.S. I mean, look, if you adhere to the belief that inflation has really peaked, and what that pass-through is going to look like remains to be seen. I think it's going to remain elevated for some time. I have to agree with Christian Mueller, but I mean, yeah, I mean, we're not really feeling it yet.
But I still am struggling to understand, heading into Jobs Day, which is a week from today, heading into this retail sales bonanza that typically happens at this time of the year. It is going to be a bonanza in the Sassower household with lots of grilling and potentials there.
Be a bonanza.
How much are we going to see, you know, a real fading in sort of the optimism in markets, just because the more that consumers keep spending, the more the Fed has to do?
Are we talking about the zeitgeist again?
I didn't say that word. If you want to go to it, it's like maybe something about that seat. Go ahead.
Look, I think the markets are really coming to terms with the fact that, you know, what is the pain trade, right? If you look at equities rates and FX globally, you know, what is the pain trade? I mean, we say it, I believe you're right. It's going to be higher rates. You know, I don't think it's weaker equities anymore. I don't think it's a weaker dollar. I don't think anyone's prepared for that, quite honestly. So, you know, for me, it's going to be a toss-up. This is going to be a higher dollar and higher rates that are really the pain trade, probably some combination of that.
I would agree with that, actually, especially higher rates. When you say higher rates, it's important to
U.S.
specify
interest rates,
U.S. long-term interest rates.
Duration.
Short-term, people I think are more prepared for it.
Yeah.
But longer-term, that's where suddenly the bet has been so far. It's, okay, let's go long-term because that's safe. You got the roll-off of the balance sheet. You have the potential for people to really reassess inflation. Right now, that does feel like it's the counter consensus.
Look at Lisa Abramowitz talking term premia, picking spots, picking maturity, key rates along the curve. This is unbelievable.
Oh boy. All right, let's look into a data check just to make sure. Right now, we are seeing pretty much nothing. I mean, I'm not going to say that this is a particularly exciting day. Look at that. The S&P hasn't moved in an hour. How many times this year have we said that? It's up about 0.1%, 4,038. And we are seeing a bit of dollar strength. Can I really call it that? The euro is at 103.82 versus the dollar. Yields up marginally, but so far this week, they have been down pretty steadily, which is fascinating considering the Fed pushback. To me, anyway. Does this make sense to you?
No, it doesn't make sense. But what does make sense is that the markets aren't moving because it's Black Friday and it's you and I sitting here. So obviously, you know, I get it. You know, nobody's watching, nobody cares.
Jordan Rochester, everyone is watching and everyone cares when you come on. I actually got a couple notes saying that we were very excited to hear potentially what you have to say, and maybe if you want to play some saxophone for us as well. G10 FX strategist at Nomura. We were just talking about the pain trade heading into next year. Do you believe that the pain trade at this point is actually a stronger dollar?
I guess that would be the case for very short-term positioning. There's definitely been a swap from we ourselves were looking for dollar to outperform. For most of this year, we were long the dollar since the start of the year. In February, we really accelerated that view. And then now we think we're at an inflection point. And I think there's a few other shops who have said the same as well, which is we've possibly seen the worst in terms of the growth data for Europe. We've had such extreme moves in energy that maybe the softer prices we've seen over the past few weeks, maybe that feeds through to better growth. Therefore, the dollar can soften. And that's the sort of trades we have on. We have long euro dollar, for example, or short dollar CNH. Then there's the reopening story for China. We know they're going into lockdowns this winter, but is it like 2020 when we had the vaccines invented in Europe and we went into lockdowns whilst they still rolled out those vaccines, but the markets just ignored those lockdowns and focused on the reopening possibilities for 2021? I think that's where we are. I think the positioning is, yes, a little bit short the dollar as a result of that. It's not too extended. If I look at the trend following nature of CTAs, they're still net short the S&P 500 on our metrics. So I think equity positioning is still short, even though we've had this big rally.
So one question that I have heading into next year is what's the main driver of some of the fluctuations? If we don't get a real direct trade, right? If we get a lot of choppiness in the dollar for a lot of the year, which seems to be honestly what a lot of people are coming to, then what drives that chop? Is it growth? Is it rate differentials? Is it something else?
Growth's the most consistent factor. So if you've got a good handle on where the growth cycle's going, if you've got a leading indicator that points up or down for the next few months, you've got to follow that. Our leading indicators, a lot of people use the China credit impulse. I'm looking at the second derivative of PMIs in Europe. They've bottomed out. They're very low. They're 2 standard deviations low on the new orders, for example. And we think that perhaps, yeah, they could get worse if we have a cold snap. The weather forecast suggests that, by the way, for the early part of December. But they shouldn't get as bad as they have been. So that's the sort of determinant of the overall dollar. So if you think growth's going up, the dollar's going down. But I agree with you. It could be a bit more choppy than what we've been used to this year. It's been a very easy dollar long for most of this year. We've had 3% drawdowns. This one, though, has been a much bigger 5% drawdown if you're still holding those long dollars. So it's changed. There is a dynamic change. And I think it could be like 2021, where if you remember Q1, we had the dollar go up by 5%, Q2 down 5%, Q3 up 5%. That's a zigzag. That's what the dollar was in 2021. Could be similar next year if we're wrong about the growth story, if we're wrong about peak inflation. I think if inflation was to reaccelerate, let's say China reopens in Q2 next year, oil prices go up, let's say $100, $110, then we've got a zigzag.
Jordan, you say growth, I think China. And your chief economist in China, Lu Ting, has been all over the property sector story for some time now. You know, I think Lu Ting even said that China's Volcker moment is now over. So if that's true, what does that mean for dollar yuan?
Indeed, Ting Lu has been all over the China story. He still has recently revised down his GDP forecast. So near term, we are expecting China to underperform on the growth side. We're seeing that with record numbers of cases. It's hard to avoid the idea of business sentiment dropping in China as a result of that. But look, we're looking for dollar CNH to head low. We've got 690 for our year-end forecast next year. I think it's potential we could go lower than that if we have the beautiful scenario for markets, the growth positive scenario, which is the Fed doesn't need to raise rates too much more. We get to a terminal rate of 5.5, let's say, and then they pause. The markets will be thinking about rate cuts because inflation, quite clearly in our view, will have peaked. We'll be looking for sub 2% inflation in the US next year. So if you have that combined with China doing a proper reopening, European or American style, then we could definitely see bigger moves in CNH.
Jordan, I run emerging market fixed income research here, and the one thing that, you know, for me, I mean, if you think about the 21 major EM crosses globally relative to dollar, only 3 are positive year to date. But when you start looking at funding currencies, for example, the Japanese yen, the euro, the British pound, it's a whole different tale. So talk to me about funding currencies as we look ahead to 2023. Which G7 or G10 funding currency looks most attractive? I'm talking to fund with, meaning it looks pretty poor relative to the dollar.
That's an interesting one. So in Japan, there's the potential for the record numbers we've seen in CPI. It hasn't been this high for a long time. The potential for yield curve yield curve control change next year makes Japan much less attractive as a funder. So the yen's not really on that list. I think the trade of the week from most on the street they're looking for is dollar yen downside based on the price action. So that's the risk there. On the Swiss side, I think that we could see some Swiss strength. We've got short sterling Swiss. So again, another funder that I wouldn't be too interested in. I think in the sterling space, that's where we could be looking. So we've got short sterling Swiss on. And I think of all the central banks, the Bank of England was the first major one to hike, apart from the Norges. And they'll probably be the first to signal the end of their hiking cycle. Given how dovish they are, you saw the last meeting, they said the market's pricing too much. I think they're on a more dovish path of communication, which makes it easier to sell sterling. The one problem with that, I think most people would agree with me. And there's a lot of consensus positions in short sterling, making our lives difficult. It's why the pound has outperformed in the past week.
Jordan, before I let you go, you said something there I'm trying to wrap my head around, that a more dovish stance leads to more currency strength. Am I getting that correct?
No, on sterling side. Okay. So if we have the Bank of England dovish, it makes UK
I thought you were talking about the S&P. The reason why I asked that, and Jordan Rochester of Nomura, thank you so much. And the reason why I asked that is because, Damien, we're looking right now at a scenario where if growth takes the priority, a dovish Bank of England, does that lead to stronger or weaker currency, right? Because a dovish typically would lead to a weaker currency because there could potentially be more inflation. But how much does it lead to greater growth prospects and strength?
Well, I mean, if you just look at the dollar, the dollar is a very different case. That's a bad example. But I mean, you're absolutely right. I mean, it's amazing that we're talking about currency appreciation when you get, weaker prints, weaker PMI prints, weaker growth prints. I mean, that's basically what you're talking about. Weaker growth is actually going to translate in a stronger currency domestically for many of these G10 players. I don't know if I agree with that, but certainly for some, I can see that being the case.
But if it's not the case, right, then it's not necessarily growth being the preeminent driver of currencies. That's why I was asking about
positioning.
That. If there is, right, but really, at what point does dovishness of a central bank become a bull case for the currency? I know this is totally counterintuitive, but bull case because it's basically allowing growth to pick back up and saying we're close to the end of the hiking cycle. Coming up, we've got Joe Feldman. Wherever he's driving, he will come back to us of Chelsea. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Retailers in the U.S. are bracing for a slower than normal Black Friday. High inflation and sagging consumer sentiment are hurting Americans' demand for material goods. According to S&P Global Market Intelligence, seasonal sales are likely to fall 1.2% after adjusting for inflation. That would be the first decline since 2009. In China, the central bank has taken another step to boost the economy. It's cut the amount of cash that banks must hold in reserve for the second time this year. The adjustment to the reserve requirement ratio takes effect December 5th. It will inject $70 billion of liquidity into the Chinese economy. To Ukraine now, where half of the capital's residents are still without power following a barrage of Russian missiles. The mayor of Kyiv warns that limits on electricity will continue. President Volodymyr Zelensky says the power situation is difficult across the whole country. Shares of Credit Suisse fell to an all-time low today. Investors are weighing the impact of the massive outflows the Swiss bank reported this week. Credit Suisse said that clients had withdrawn $89 billion in the first 6 weeks of the fourth quarter. And Elon Musk says Twitter will relaunch its verified service next Friday. Earlier, Twitter suspended the $8 subscription program to fight a growing problem of users impersonating major brands. Twitter verified Musk's attempt to distinguish between different classes of users and also to drum up some much-needed revenue. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Stages of a sustainability revolution that has the magnitude of the industrial revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority. The top names in climate change are on Bloomberg.
Building out local wind, local solar, hydrogen, these are solutions to not just climate issues, but geopolitical issues. We are in a position by 2030 to have 80% of all electricity generated by wind.
Renewables are the safest, the cleanest, and the cheapest form of energy today, especially for countries such as Greece.
Nobody covers climate change like Bloomberg, your global business authority.
This has been the least loved dollar rally in history. Throughout the year, we've gotten tons of pushback on the dollar bullish call. Leveraged funds have largely sat out the rally if you look at positioning.
Eric Nelson, Wells Fargo currency strategist, talking about what may become the consensus that there will eventually be dollar weakening. When and how quickly and how consistently, of course, is another story. It is Black Friday, Damian Sassower, who is in for John Farrow and Tom Keene. And we've been talking about the consumer. Can I just say, editorializing for a second, I am so glad the 4 a.m. shopping mobs are gone, because that seems to be the theme of this particular season.
Well, I'll tell you this, we're going to talk to, Joe Feldman in just a minute, but, what's interesting about many of the malls and, going in the foot track and going physically in person to shop at these places is the parking. You have to pay for parking now at the mall. I mean, it's crazy. In White Plains, it's $2 to $3 to $5 to pay for parking just to pay to play. They want to draw you in. I think they need to give you a little bit of a discount, a little promotion, a little incentive to actually park your car there.
This may be a New York City region issue rather than a national issue. We will discuss your parking situation later on. Right now, let's head over to Joe Feldman, who's been driving around and getting out of the car and paying for that parking, a senior research analyst and assistant director of research at Telsey. Joe, where are you now? And do you still see the same kind of softness in terms of volume?
Yes, so I'm still in White Plains, and I'm in a Dick's Sporting Goods. I was just in Target a few minutes ago, and it's still pretty quiet out there. We're seeing a little more traffic picking up, and, talking to some of the store associates around here, they're hoping and expecting things to pick up as the day progresses, and I think that will be true. Even the mall down the street, the big main mall in White Plains, it doesn't even open until 9. So if that tells you anything.
Yeah, it tells you that those eras of people crowding in to get the doorbusters maybe are gone, which I'm sure a lot of people are not that sad about. But it does raise an issue of the activity of shopping versus the sort of mercenary aspects of it, Joe. How much can we actually get a read on the holiday season based on foot traffic right now, given that so many people are just going direct to online to shop for what they want at the bargains that they see, and then they're going out as a social event to shop in a physical way?
Yeah, I think that's a terrific point, that it's really hard to just walk in a handful of stores or to spot check stores and to get a sense. At this point, you really need to see what the day looks like throughout the whole day, the weekend. Try to leverage some data that we have access to see online trends. And I think you're right. People have been shopping. They've had the ability to shop for the past several weeks and get great prices, and a lot of it's price protected. So if you bought something earlier and you see the better price later, you'll get that discount. And the consumer, has the opportunity to just sit on the couch and shop. And I do think that we're seeing spending levels will be okay for this holiday season. And so it's hard to make too much of a read on an early, Friday morning, just the day after Thanksgiving.
Well, Joe, you were just at Target, and I believe in your last note, you were surprised by the magnitude of the demand drop on discretionary items at Target since mid-October. Talk to us about, Target. Will inventory markdowns, will promotions be enough to get margins back on the right and to create some top-line growth?
Well, we're hoping that will be the case. I do think that the promotions and the discounts will help to drive the traffic, to drive some of the spending levels. And, I will tell you, there were some good deals on the toy business at Target this morning, which makes sense. They did have excess inventory. They talked about a slow start in the toy season. And for all the traffic that was in the stores, that's where it was centered this morning, believe it or not. There was quite a few people in the toy department. But I did see, pretty good signage throughout the store, highlighting deals and highlighting some of the value that you could get at Target on some of the discretionary items that were good gift givers.
Well, Joe, you're in front of Dick's Sporting Goods in White Plains, and you raised your price target on Dick's to $135 just a few weeks back. What is driving demand for fitness and apparel? And while you're there, can you just get me a quote on the TaylorMade Stealth 9.5 degree stiff shaft, please?
Exactly. I'll tell you, Dick's Sporting Goods is really doing a great job. They've emphasized the apparel and the fashion element of the apparel and footwear within sporting goods, which is very hot right now from a trend perspective. And I think that they've leaned into it, and that's helped. When you walk into the stores these days, whether it's in White Plains or around the country, the Dick's stores look terrific. They're well stocked, well merchandised, and it is product that's comfortable, and yet you can wear it to work and you can wear it to work out. So I think they've done a very good job, and that's just attracted more customers. And then when you look at their footwear department, it's much more on trend, and they're getting some of the strong brands, and they get the best elements of those brands as well.
Joe, I want to ask a sort of delicate question. Damian brought it up earlier about the shooting in Walmart in Virginia and the question of safety and whether that's been an issue for people in this holiday shopping season when they go in person. How have stores responded to that in terms of whether it's the petty crime, the shoplifting that we've heard a lot about in a lot of the earnings calls, to the more extreme version and the tragedy that we saw just recently?
Yeah, it is a concern, and it's something that the industry is talking about nonstop these days. Is the amount of theft that's happening, and then the horrible incidents. Thankfully, don't happen too often, such as what happened at Walmart. But the retailers are trying to have a little more presence at the front end of the store with their store associates, as well as occasionally having a security officer or an off-duty police officer at the front of the store to just have that presence and awareness and try to create the safety. You're also seeing a lot more product that gets locked up these days, especially some of the more valuable things that can walk away easily. You see some of it behind glass. You see it locked up. And I think the retailers are working hard right now to try to figure this out. I think they're trying to work with law enforcement and lobby with them to try to, help prosecute some of the people and make changes in the way that shoplifting laws are currently situated around the country.
Joe Feldman of Telsey, thank you so much. I really appreciate that. And Damian, I do wonder, especially with locking things up, for example, in drugstores. Have you seen that as well, where everything's locked up or a lot of things are locked up? Yeah. And I wonder how much that actually deters people from shopping in those in those areas rather than just ordering it online. If you have to flag someone down and have them open it, and it's a different experience.
I find it notable that they lock up the razor blades, right? Because for me, you give me razor blades for free, you might find me dead in, like the shampoo aisle or something like that.
You definitely took this a different direction.
No, I get it.
I don't think that's the purpose.
No, I think it might be the purpose. I mean, like hair color. It's, anyway.
No, I know, but look, it is notable to me because it is a deterrent, because it creates friction, and the whole goal of the retail experience for so many years was to eliminate those frictions. If those frictions are made even more insurmountable or more significant, you have to think about it. I wonder how that kind of changes the dynamic of which stores get traction in store versus those that are more catering to online.
Well, you look at Dick's Sporting Goods, they have like a golf simulator inside. You look at Target, they have food and beverages, right when you walk in that you can purchase. So, it is about the experience. I think that hasn't changed, but I don't think it's been a focus for the retailers this season, given we're coming after 3 years of a pandemic.
Yeah, although it is the first Black Friday, so we shall see later today whether people do get out there more en masse. Right now in markets, we're seeing just a rip-roaring rally of 0.06%, 4,035. We're seeing yields marginally higher. And coming up, we're going to speak with David Page, AXA Investment Manager's head of macro research. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When I started, I had no idea it was going to turn into this. It's a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
Welcome back. This is Bloomberg Surveillance on television, on radio, on this post-Thanksgiving Friday. We are heading into a day of perhaps, can I say sluggish trading, Damian Sasser?
Sluggish is a good.
Yeah, I think so.
adjective, yeah.
Sleepy. It's a sleepy. It's a, what's the tryptophan-induced kind of trading session. 40.34 on the S&P, up nothing. It's basically flat. We're looking at the euro dollar, basically flat as well, 103.66. We're looking at yields that are up, 5 basis points. Nothing to write home about. 3.74%. Perhaps a reset after the incredible decline that we saw in yields over the past few weeks and just recently. And crude, interestingly, a little bit higher, which doesn't make a lot of sense to me, Damian. I got to be honest, because if you think about the lockdowns in China, are people just shrugging it off and saying, whatever, it's been priced in?
Well, Brent crude's a man's contract, and there's a lot of different factors that are going to impact the price, certainly on a day-to-day basis. But you're absolutely right to point out China. I mean, China demand has been the driving factor and the driving force on crude prices, and the fact that we're trading below $80 is unbelievable to me.
And the fact that we're looking right now at the lockdown of this capital city, Beijing, which has not yet been locked down. We're also talking about Black Friday. This is, of course, the traditional day when everyone wakes up at 6 a.m., 4 a.m. and goes shopping. Evidently, nobody does that anymore. But Bloomberg's Kriti Gupta did. She's down in New York's Herald Square outside of Macy's. And you were talking about the experience in the store. And I'm wondering, can you just describe it? Because ultimately, increasingly, in-person shopping is about the experience.
It is about the experience. Look, we entered into the den inside Macy's and essentially said, look, some of these shoppers, it's interesting, they're not actually shopping. They're going in, they're checking out the products, but they're not checking out in the store. And I think that's really interesting, this idea that they're actually looking at the products, the perfume, the shoes, the clothing, but then they're not actually taking it home. They're going to go home, they're going to buy it online, have it delivered to them. It's a really interesting dynamic. It's almost kind of like the pop-up shops that you see across New York City. That's what these department stores have turned into. But in terms of actual crowds instead of actual foot traffic, still not coming up to the levels that we've seen in the past years, at least pre-COVID. And that's, I think, going to be the real litmus test, Lisa and Damian, this idea that if they aren't in person, are they going to make up for it online?
Well, Kriti, I mean, talk to me about inventory levels. I mean, are you seeing, well-stocked racks? Are you seeing, ladies' larges? Like, I mean, that's what I wear. No, I'm just kidding. I mean, are you seeing, is there enough clothing? Is there enough, is there enough stuff out there to get people to reach into their pocket and actually make a purchase here on Black Friday?
You know, it's interesting. There's so many items there. In fact, I was looking at just some of the racks for my own personal shopping needs, I have to admit. And even then, there were just so many things. They're not flying off the racks anymore. And this is what I mean by they're looking, but they're not checking out. And this is going to be really crucial because even though you do see full shelves, full racks of clothing, there is still plenty of inventory online. And the prices actually are cheaper in person. I was looking at some of the pricing on, say, a purse, for example, that you saw in Macy's. I won't name the designer, but you saw them. It was marked down like 60%. You look online, it's only marked down about 30%. So it's almost interesting that they're making up the margins through e-commerce rather than in person. An interesting dynamic as I was window shopping.
Kriti Gupta, thank you so much. A lady's large. Damian, I'm not going to let that go.
Well, Kriti just said purse. My wife would have corrected me and said it's called a pocketbook, not a purse.
Really?
Yeah. Oh, yeah. That's a big no-no.
Do you do the MERS?
I don't do a MERS,
okay.
no.
Maybe
I don't carry anything of worth.
Yeah. Okay. We'll leave that there, and we'll get into your shopping habits and your desire for a grill, and you can send your grill recommendations to Damian Sasser as well as your Ladies Large homepages. David Page joining us now. Really, the focus on the consumer in the U.S. front and center, not only for the U.S. but globally. David Page, head of macro research at AXA Investment Managers, partly because the demand in the U.S. Some people, including European policymakers, have accused that as being a main driver of the inflation that we have seen globally. How long will that continue to be a driver of sustained support for the global economy and for the goods companies around the world?
Well, I think for the sustained driver of global activity, I don't think it's going to be much of a driver as we move into early next year. We are expecting to see relative softening come through in consumer spending in the US from the fourth quarter, and we think that'll have quite a material impact as we move into the sort of first half of next year. And certainly, I think the idea of the US bringing activity from the rest of the world. It is really not going to be the case. What we are seeing still is domestically generated inflation in the US, which is something that the Federal Reserve has to concern itself with. So it's not just that we saw supply chain shocks, it's not just that we saw an energy shock. There has been a very tight labour market in the US, and that's sustained inflation in the US, and we think it will continue to do so somewhat throughout 2023. So I think there is for sure a domestic inflation issue that the Fed is about addressing, but I don't think it's something that's going to drive global activity as we move into 2023.
This inflation that is domestically driven, partly or in large part because of the consumption that we see ongoing today and into the holiday season, do you think that people are underestimating the resolve of the Federal Reserve to slow that and to raise rates beyond where they previously believed, simply because they need to get this under control, and there still is this resilience?
Yeah, I think there is a misapprehension coming through. I'm not sure that people misunderstand the Fed's resolve to get inflation down. I think they get that now, but I just think they think that's going to be a lot easier than we do, and I think probably than many on the Fed do as well. So there is an expectation that we see inflation fall back very sharply across the course of next year, and that against a backdrop where some of us are considering the prospects for mild recession in the US, others perhaps not quite that far, but certainly a slowdown, suggests that the Fed will be comfortable enough by the end of next year to begin cutting. And I'm not sure that's the case. We see a much slower decline come through in inflation, certainly falling. We would expect to see inflation close to 4% by the end of next year, but still not enough for the Fed to sort of ring the all clear. And consequently, I think you could see the Fed delaying those cuts coming through that markets are pricing. And let's be fair, the Atlanta GDP Now tracker is suggesting quarterly growth in the fourth quarter of some 4%. Now, we have questions about whether that will actually materialize, but if it does, then the 5% peak that we're expecting from the Fed early next year might have to be higher still. And I think that's the point that we'll hear Powell making, certainly in the December meeting, but quite probably when he speaks next week as well.
And so it's all about the data, David. And so, looking ahead to next week, we do see core PC. I think it's supposed to moderate somewhat. But more importantly, on Friday, we see payrolls. And we've now seen 22 positive payroll prints in a row going back to, December 2020, I believe. So, my question for you is, can we expect to see some negative payroll prints in the near future? You're talking about U.S. economic resilience, and I get that. But, at what point does unemployment start to tick up here?
Yes, we think so, but I think you're going to have to wait until next year. The key surprise of this year, right, has been the resilience of the labour market. We've already seen 2 quarters of contraction from US GDP in the first half of this year, but we were seeing gangbuster rates of growth. Even now, with the slowdown that we have seen coming through in payrolls, it's still posting 261,000 increase in October. Still a pretty healthy clip, right? Now, the household survey, which also comes out with a labour report, showed a much weaker picture, and this was also the case in the second quarter, which heralded a slowdown in payrolls going further along. So I think there is a slowdown coming through, and I think the Fed is acknowledging that, and that's part of the reason why it's talking about moderating the pace of hikes relatively soon. But at the moment, we've been consistently surprised at how resilient the labour market has been, and I think that's where the short-term risk is. But no, as we move into early next year, we are expecting to see payrolls slow back. We think that you'll see a few months where payrolls actually falls, and we think across the course of next year as a whole, unemployment is going to rise, not massively, and even though we're forecasting mild recession, we see a relatively modest pickup in unemployment from about 3.6 at the end of this year to about 4.5. So, it's not a huge increase in unemployment, given that we're suggesting there's going to be a mild recession, but nevertheless, we should still see one. And arguably, the Fed needs to see that increase in unemployment to ease those domestic inflation pressures.
Well, David, let's take that through to asset prices, right? Because the Bloomberg Global Aggregate Bond Index is down 16.2% year to date, the death of 60-40, so to speak. If what you're saying is true, if we're going to see a sort of a shallow, maybe not a recession, but slower growth, inflation's going to come in just a bit, but not too much. What does that mean for fixed income? What does that mean for equities? What does that mean to your 60-40 portfolio?
So I think you've got 2 questions. What does it mean over the broader term? We are expecting to see this mild recession. That does mean that the Fed is probably going to peak at around 5%. We have got rate cuts penciled in for 2024, but not for 2023. So, at some point, it does suggest that, US Treasuries at around this level are probably about right, and that equities at some point can think about recovery phases as we look a little bit further out. But I think the question is how smoothly we're going to get there. Yeah. The markets assume there are no further bumps in the road. What we're suggesting is you've got very strong GDP being flagged by the now trackers at the moment. There's a resilience, or there's a risk of resilience still in the labour market coming through, and the Fed, I don't think, is in a mood to take any chances with that. So I think this assumption that we've got an easier Fed coming through, that it's basically all done and we can look forward to the cuts now, is probably a little bit aggressive. And so the easing in financial conditions that we've seen really since that October CPI print, I think, has been overdone, and it's going to make the Fed uncomfortable, and that's what I would look to see pushback from.
David Page of AXA Investment Managers. Have a wonderful weekend. Thank you so much for being with us today. I do want to bring you this, Damien, this crossing about the European Central Bank imposing higher capital requirements on certain lenders, including BNP Paribas and Deutsche Bank. This, according to sources that spoke with Bloomberg, Steve Aarons, and Nicholas Comfort. Because, basically saying, tightening the screws, saying, I'm not worried about necessarily your stability or be able to exist, but lending requirements and the leveraged loan complex being perhaps a little bit overly aggressive, which comes after a period of froth that's really been tightened up naturally by the markets.
Mahesh Billingham, my colleague who runs European credit for BI based in London, has actually signaled spreads in Euro credit, IG and high yield, as being one area where he sees some potential room for compression into the new year, which is kind of interesting given the overhang. So, look, I mean, if you look at U.S. spreads, I think it's going to be sort of an offset to yields here in the U.S., IG and high yield. But in Europe, it might be a different story.
It's interesting, though, that the ECB is looking to crack down on banks that already are facing a whole slew of potential issues. Coming up on the Open, Peter Chatwell of Mizuho, Louis Fickmore of Aberdeen, and Ann Milletti of Allspring Global Investments. From New York, this is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Shoppers may have a little more elbow room this Black Friday as inflation weighs on their budgets. And those who are willing to spend are looking for bargains and turning to less expensive stores. Consumers will also be digging into their savings and relying more on buy now, pay later services. Thousands of Amazon warehouse workers in about 40 countries will mark the Black Friday sales day with protests and walkouts. They're demanding better wages and working conditions in a campaign called Make Amazon Pay. Employees in the U.S., UK, India, Japan, and Australia are among those taking part. Amazon says it takes its role seriously on what it calls these important matters. Bloomberg's learned the European Central Bank is imposing higher capital requirements on lenders, including BNP Paribas and Deutsche Bank. It argues the banks have ignored warnings to cut risk in the lucrative business of leveraged finance. Deutsche Bank executives have said they don't agree with the ECB. And shares of Manchester United jumped in pre-market trading. Saudi Arabia's sports minister told BBC Sport that the government would support private sector bids for the team, as well as for Liverpool Football Club. Now, earlier this week, Manchester United's owners said they were exploring strategic options that could lead to a full sale. Global news, 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Market is going to be key. And what we see people doing now is, even though mortgage apps are picking up as the rates have gone down, probably trading down to lower prices. We see the downward pressure on prices. Thankfully, compared to 14 years ago or so, people have not been treating their houses like piggy banks with so much home equity.
The big question, will we or will we not see some sort of big downturn in housing prices given how high mortgage rates have gone up and given the lack of affordability? This has been one of the key questions. That was Luke Tilley, Wilmington Trust chief economist. Right now we're looking, S&P futures have turned down. Wow, it's really, again, fluctuating. They've been all over the place, 40, 30. We're seeing right now in the S&P down less than 0.1%. We're seeing the euro basically a little bit softer versus the dollar, 103.67. 10-year yields up just marginally, 3.74%, and crude with a little bit of a lift, which is interesting in light of the China news, given that we did see is this lockdown in Beijing, the capital city of China. Jonathan Farrow and Tom Keene are off today. Damian Sasso are very much in, and housing to me is one of the big underpinning bets of next year. How much can we still see some sort of resilience in pricing given the mortgage rates, given the lack of affordability?
I mean, it is the big question, right? I mean, housing affordability in the U.S. is at an all-time 40-year low, right? So my point to you is this: with mortgage rates at 6.88 and elevated interest rate volatility weighing on commercial, developers, commercial borrowers, commercial loans in general, where's the regional variation, right? I mean, where is, supply growing? I mean, it's not, right? And where is demand growing? It's not supposedly right now. So, for me, it's going to be, and we have a great guest. I mean, I think it's the interview of the morning for me. trying to understand what the U.S. housing market's going to do, and getting Jonathan Miller on here is going to be very helpful.
Well, let's get right to it then. Jonathan Miller, President and Chief Executive Officer of Miller Samuel. Jonathan, how much are we going to avoid some sort of significant pricing downturn, or is that sort of increasingly inevitable, certainly in certain hotspots?
Listen, I think what is, and I hate people that say this time it's different, but this time it's different, is this idea that, and what hasn't really been into the calculus has been the lack of supply, that inventory has been literally obliterated. I think, we did a study of all the markets we cover in Florida, and inventory compared to pre-pandemic is down about 43%, which is a huge drop from the past cycles where inventory was piled up after the music stopped. I don't think there's any doubt that we're going to see modest declines in certain markets, but the combination of tight credit policy all through this housing boom, on top of a record amount of home equity that has been compiled, it's hard to imagine a significant drop in pricing. Inventory is just too low.
How could you see, though, Jonathan, this progressing over time? I mean, what I see out there right now in the numbers is a lack of mobility, people not selling, people not moving because they're going to have to take potentially a hit or have to wait a very long time. And where are they going to move to? You're seeing rents kind of stabilize. Longer term, if interest rates do not come down materially from the 7% where they are right now, what is the future path? Is it basically range-bound housing prices in the U.S. for the next 5 years?
Well, I think that's probably the scenario if rates don't come down. The thing is that consumers are wedded to the rates that they enjoyed through a refinance or purchase during the pandemic housing boom. And so inventory, in many ways, because of high equity, people aren't going to be pushing sort of the boundaries. There isn't an urgency to sell or to move, unlike the housing bubble where people lost their jobs and were unable to sell because they were underwater. This is a very different scenario where inventory is the biggest change in condition. And when we talk about inventory, we have to make sure that we clearly separate existing supply versus new construction, because new construction has more upside risk for oversupply than existing product, which is about 90% of supply nationwide.
Well, let's talk about new supply here. I mean, for me, elevated interest rate volatility is absolutely killing commercial developers. I mean, these rate caps on ARMs, right? You know what I'm talking about here. They're being triggered. And so, they're driving up the cost to borrow a $200 million commercial loan. You now got an additional 5 to 10% you have to account for that, because that's what the interest rate caps cost once they get triggered due to all this interest rate volatility. Talk to me about an environment where rate vol comes down and what that means for commercial developers across the U.S.
Well, it improves the situation, but the problem with commercial, and if we're talking specifically about commercial office, I think that'll be the last sector to. I don't even know if it has the potential to recover in the next several years, because of remote. That is not going away. So in the commercial world, commercial leasing is in a very difficult spot, and it's going to have to be reimagined. Seeing in that sector right now is that besides financing costs, there's a concern about overbuilding. So and rents look like they're starting to come down nationally. We're seeing that in many of the markets that we cover. So I think you're looking at a residential recovery much farther in front of a commercial recovery.
But Jonathan, just real quick here, what does that mean then for the biggest cities? I know you cover New York City so well, but if commercial doesn't recover, if the office space doesn't recover, what about housing markets in those regions?
Well, what we're seeing right now is this incredible disconnect where markets like New York, which are seeing record housing prices and record sales activity up until the Fed moves, and rents just starting to come off of their peak. At the same time, we have, using the Castle data, we're seeing 60% of the stock unused, remote is going to have a profound impact to the point where I think we're going to have repurposing on the margin to some sort of multifamily residential. But I don't see that as the panacea. I think there's a broader challenge there with zoning, conforming to CFO requirements. It's a long slog. It's not a short term. This is a long problem going out that remote has put in place. It's not the pandemic. It's the pandemic that triggered remote, and there's no going back, in my view.
Jonathan Miller, President and Chief Executive of Miller Samuel. And Damian Sasser, we'll have to discuss that more, because what does that do to the housing market, let alone the office market for big cities?
Well, I think he's really talking about inventory to home sales and the bifurcation we're seeing in places like Phoenix, San Francisco, and Denver relative to New York, Boston, and Chicago, which have remained far more resilient. For me, it's cost to income for households in the U.S. At what point, is it a third of your income? Like, what should housing really cost an average household? And I think that's the real question.
It's a great question. Damian Sasser, such a pleasure having you on. Thank
you.
Happy post-Thanksgiving Open World Cup kinds of watching this afternoon, because that is what most people will be doing. Coming up in the Open, Peter Chatwell of Mizuho, Luke Hickmore of Aberdeen, and Ann Leddy of Allspring. This is Bloomberg.
What's happening on Wall Street?
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. Right now, we are looking at sleepy markets, although turning down as we head closer to the open. The countdown to that open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
We begin with the big issue, the holiday shopping season kicking off.
Black Friday.
Black Friday.
This is a Black Friday like no other. There's definitely good interest.
I'm really optimistic.
I do think it's going to pull forward sales from Christmas.
We saw the early start to holiday.
Consumers have delivered this year.
This is an interesting year.
Consumer sentiment is at a record low.
We have had a very steady pace in terms of overall spending, and the labor market is great.
There's still a lot of pent-up savings. There's still a lot of liquidity in bank accounts.
People, when they have income, they spend it. Americans have income.
Most retailers expect it to be a sort of subdued holiday season, not a disaster, but a more promotional holiday season.
And honestly, I'm not too worried about some of these businesses, the big businesses, taking a little bit less in profit.
A fascinating moment. Joining us now to discuss Aberdeen's Luke Hickmore and Peter Chatwell of Mizuho. Both of you, thank you so much for being with me. Luke, I want to start with you. We heard all that optimism about the consumer and how much they're spending. You push back. Why?
I think the consumer is kind of struggling a bit in the US. If you look at the rise in unsecured debt, in particular credit card debt, really since January, February this year, it's been extraordinary. And it points to me that the real bit of the consumer that's spending, those on the middle and lower income cohorts, are running out of those savings if they haven't run out of them already. So discounts are going to have to be heavy to get them to borrow more. I think the December and January borrowing stats are going to be some of the most important economic stats we're going to see for months and months and months.
Meanwhile, Peter, do you agree with that, this idea that potentially we're seeing the last gasp of the consumer?
Last gasp, I don't know. I think it has surprised a number of observers just how resilient the consumption has been, and if it has been simply extending credit lines to do that, then it makes a lot of sense. But a thing I would add to what Lucas said is that it was actually the surprise resilience on the consumption and generally the US economic momentum, which has meant the US is likely still not in recession yet. And that, in my mind, is really important when it comes to analysing just how far the neutral interest rate in the US may have risen.
Well, Peter, let's build on that. This question of we might not be at a recession yet. What will be the telltale sign for you that we are indeed in recession, that we're starting to see the pain in force coming through?
Well, I think if you look at the US economy from quite a global perspective, I think most people would be very surprised, most models would be very surprised as well, that after such a period of volatility and a massive rise in interest rates and also profound dollar strength, still the consumer is still going. Most sectors in the economy are still not yet in contraction. And that, I think, for the scale of the monetary tightening that's already been delivered, is something of a surprise. And that, to me, suggests that next year, when economists and when the Fed is assessing the appropriate level of monetary policy for, the neutral setting and where they may be setting policy over the medium term in future years, I think they'll probably assess that this drift lower in the neutral rate, R star down to 0, has reversed, and now we've got a phenomenon of R star actually rising up significantly above where it has been over the last decade.
Well, the latest Fed minutes signaling that recession could be shifting into the Fed's base case, reading, quote, the staff continued to judge that the risks to the baseline projection for real activity were skewed to the downside. It viewed the possibility that the economy would enter a recession sometime over the next year is almost as likely as the baseline. Luke, this is part of what's underpinning, I believe, your view that we're going to get to that terminal rate maybe and stay there for perhaps a little bit, but not the protracted period that people think. Please explain.
Yeah, I think that's part of it. And I keep trying to remind myself, I suppose, that everything's happening in this business cycle at a very, very, very quick pace. We've gone into it quickly, part of the invasion in February in Ukraine. Inflation took off at warp speed. Interest rate rises have been very, 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 very quick, and it'll probably be that way for the next few months. I think to think that it doesn't end quickly and come off the other side quickly just seems a bit disingenuous, really. And I think a lot of that may well be around, as they say, if you look at where the income brackets are, how well they're feeling about life, how they're spending their money, and they are actually finding it pretty tough now. So, yeah, not in recession yet. I think we will be getting into a recession quite early next year. It's going to feel different because nominal growth is going to feel fine for companies for some time. But for real growth, it's going to be tough. And real wages, that's the thing. That's what, for me, really pushes us into difficult times early next year.
And this is a reason why a lot of retailers are expecting a pretty muted holiday season, perhaps the first real sales decline when you strip out inflation going back to 2009. You've seen that inventory buildup forcing companies into widespread markdowns, which could mean a hit to profits. For more, joining us now, Bloomberg's Kriti Gupta at Manhattan's Herald Square. What do you see out there, Kriti?
Well, look, you hit it right on the head. The idea of an inventory buildup is really crucial. 33% year over year, Lisa, and yet there's kind of a fine balancing act between a lot of retailers. Sure, inside Macy's right now, the shelves are stocked. The racks are still fully stocked with brand new merchandise. The trick is they have to get rid of it, even as consumers actually spend more than they were expected to pre-pandemic, to the tune of 2.5% year over year spending growth. Lisa, the tricky part here is simply the fact that you are seeing extremely high promotions, extremely high markdowns. But at the end of the day, is it going to be so much promotional excess to the fact that they get rid of the inventories, but then at the end of the day, not make as much money and then ultimately lose on their balance sheet? That seems to be the balancing act right now for a lot of the retailers, Macy's included.
Kriti, what's the traffic like out there?
You know, it is not the trampling or long lines that I was expecting. In fact, it's actually all pretty calm. A lot of the folks here are just looking at simply the merchandise and then choosing to actually shop back online. They don't want to carry the bags. They don't want to necessarily shop in person as they used to. But I should say at 5:30 this morning, there was a line around the block, Lisa. Perhaps not the kind you saw 5 years ago, but still people really loving the in-person experience.
Kriti, thank you so much. Have fun. And Luke Hickmore and Peter Chatwell are still with us. I do wonder, Luke, given the fact that people are out there, that people are discussing this, and given that Peter believes that inflation is going to remain higher for longer, that higher are starred, where does a recession leave us when it comes to bringing down how quickly prices are going up?
Yeah, so we need both the recession and higher unemployment to really get inflation down. And in that sense, I guess I agree with Peter to a degree. I do think inflation is going to come down next year, and we're probably looking at 2% lower per quarter as we go through the year to the end of the year in the 3-ish kind of area, I guess, which I guess is going to be way below what Peter's thinking. And it's what supports my 4.5% peak in the first quarter, maybe first half of next year, rather than getting to the market's 5% kind of number. And it's going to take a few things to get there. I fully accept that. I could easily be wrong. It's basic. We've all been wrong on inflation for the last 2 years. But it is hard to keep these numbers going year over year over year over year over year. I think we do slow, as I say, 2% a quarter.
So, Peter, how do you push back against that, saying that, yes, the comps are hard in order to keep posting these kinds of numbers, but if we get down to a 4% inflation rate or a 3% inflation rate, it's vastly different than struggling to get to 2. How do you sort of frame out the drivers of inflation that will keep that R-star higher?
Yeah, I think that it's once that 4% inflation rate is analysed, and it's the strength in the underlying inflation that's still showing itself to be prevalent, a lot of the goods prices through massive base effects will be much lower, if not in deflation. But underlying inflation, I suspect, is still going to be very strong. And Luke talked about the labour market. That's absolutely important. I don't see many factors other than a much deeper than expected recession that is going to get unemployment up to a level where it is no longer posing structural upside risks to inflation. So I think it's almost a tautology that unless we have a super deep, much worse than expected recession, I don't see the inflation risks going. Geopolitically, I assume the situation is going to remain unchanged from as it is now. And I think the domestic political agenda for most major economies is still going to support a reshoring of productive capacity. Therefore, economies are going to have greater levels of friction on a structural basis. We're going away from globalization, not reverting back to it.
Well, but that really leaves a question, Luke, when it comes to margins, that essentially if consumers are getting really compressed when it comes to their real wages going down, and at the same time you see this persistent inflationary push, how much do you see margins ultimately take the hit, and do you not want to be in certain equities?
Well, Lisa, I think margins are going to be absolutely key for all of us next year. Generally going to be all right, I think, for most of 2023, but the kind of wage settlements we're seeing coming through now, even with the lower inflation, whatever that outturn ends up being, those wage settlements are going to be higher for the next 2-3 years as they catch up on real wage growth. So, yeah, margins are going to be tough this Christmas for a lot of retailers. They're going to be tough right the way through next year for pretty much every section of the economy. But you wait. When we get into 2024, margin's going to come under a lot of pressure, and we could be looking at some quite severe cutbacks on people's projections for EPS 24 out through 2025. And 23 is already seeing cutbacks on people's EPS projections. So, I don't think equity markets have finished with this current inflationary pulse, and what happens after it. I just mind your eye that this rally doesn't feel like it's got legs for much longer.
Luke Hickmore, Peter Chatwell, both of you are sticking with us, and we will continue this conversation. Coming up, EU trade ministers gathering in Brussels to tackle a host of issues.
We must assess our dependencies on other authoritarian regimes, not least China. We must manage the risks, reduce our vulnerabilities, and increase our resilience.
That conversation up next with European Trade Commissioner Valdis Dombrovskis. From New York, this is Bloomberg.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We're seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
When U.S. jobs numbers are released. Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
We need a decent compromise. If we agree on some kind of price cap that doesn't threaten the security of supply, I think a very strong message for the market in terms of decarbonizing gas in general. Keeping unity in this situation is paramount. We cannot let Russia divide us on energy.
EU trade ministers wrapping up a meeting to address a host of issues, including U.S. trade relations and the Inflation Reduction Act. Joining us now with one of the most important interviews of the week, Bloomberg's Maria Tadeo in Brussels with European Trade Commissioner Valdis Dombrovskis. Maria.
Yes, thank you so much. And we are joined here from Brussels by the Executive Vice President of the European Commission, but also handles the trade portfolio. This is one of the biggest issues today. And of course, the focus point is on the Inflation Reduction Act. What is going on between the European Union and the United States? And are we heading ultimately to a trade war?
Well, we just had those discussions among EU trade ministers, so EU-US trade relationships, also in the context of upcoming Trade and Technology Council, which is going to take place in Maryland on 5th of December. So there are many avenues how we are deepening our cooperation in trade area, but at the same time, there are major concerns concerning this Inflation Reduction Act and the discriminatory provisions against EU companies across the whole range of areas, electrical cars, batteries, renewables, energy-intensive industries. So currently we have a joint EU-US high-level task force, which is working on this and hopefully producing the results. I would say the message from the ministers was very clear, that we need to see concrete results and we need to see the EU concerns addressed.
And you've talked about concerns now. You also said discrimination, potentially. The concern is that Europe is not going to get a good deal out of this. But I wonder, in the talks that you have already with the Biden administration, do they listen? Do they understand the problem? Because the Germans say potentially the issue here is that they just don't understand the concerns. It's not they want to fight a trade war. They just don't understand the problems for us.
What we are asking is basically fairness. We want European companies and European exports to be treated the same way in US as US companies and US exports are being treated in the EU. So that's what we are asking. To give a concrete example, for example, electrical vehicles. We are also providing subsidies in EU for electrical vehicles, but we are doing it in a non-discriminatory way. So also, for example, European consumers can buy Tesla made in US and get the subsidy. And actually there are consequences. For example, in September, the most sold model of the car in Germany was Tesla Model Y. So in a sense, we want to have the same non-discriminatory treatment also in case of US subsidies.
And can I ask you, you talk about the talks, of course you referred to Tesla, I guess you want to see German cars also, not just German, but Europeans also being sold in the United States. When do you expect the Biden administration to say, okay, we hear you, we can fix this? And the question is, if they don't, do you foresee that ultimately we're going to go back to a replay of the Trump administration with tariffs going both ways?
EU and US share strategic partnership, and I would say it's especially important in current geopolitical context when we are dealing with Russia's aggression against Ukraine. So it's important that we are cooperating and we are united, and that's indeed why it's so important that this Inflation Reduction Act is being addressed and it doesn't become another irritant in our relations.
And of course, you mentioned the context of the war here. This week, we've seen a lot of talks, but not a lot of actions on things like the price cap. Again, some of the tensions between the different member states in the European Union. Will this unity hold, especially as the winter gets tough for Europeans in the face of Russia?
Europe has responded in a united and strong way. So far, we had come forward with 8 packages of sanctions against Russia. We had provided substantial support to Ukraine. We are determined to continue so. Currently, indeed, there are discussions on price cap on Russian oil. I would say it's not only among the EU, but because we need to agree it at a G7 level, because it's a G7 price cap. So, yes, there are discussions. There are countries which are insisting on a smaller price cap, because it's true. If you put price cap too high, it's not really, it doesn't really bite, because actually oil is the biggest source of revenue for Russian budget. So it's very important to get this right, so that it has really impact on Russia's possibilities to finance this war.
And some say ultimately Vladimir Putin, with this cap or no cap, he's still making money. In your view, and of course you come from a Baltic country, should the European Union, the West, to increase the pressure further, you have to break the Russian economy, and that means the energy.
Indeed, I think we need to continue to put pressure on Russia as long as aggression continues. So now the next practical step is indeed this price cap, and it's important to get it right, to find the right level that really bites.
Mr. Dombrovskis, I know you were in Ukraine last week. Before we get into the help from Ukraine on the European side, I wonder if you could describe the situation there, because we get reports that the country is now very cold. There's no water, there's no electricity. This is happening in 2022. For many, it's incredible that you have a country that's gone blackout. When you were there, what was the situation like?
Indeed, I was in Kiev last week, and the situation is very serious because Russia is deliberately targeting Ukraine's civilian infrastructure. So there are problems with access of heating, electricity, water. So they are really aiming for humanitarian catastrophe, because it's getting cold. Winter is starting. There was already snow in Kiev last week. So also from that point of view, it's important we provide Ukraine with necessary air defense systems so that they can protect their critical infrastructure and ensure minimum functioning of all those key utilities.
And of course, you have been outspoken about Russia and some of the threats that it poses. The idea now for some is that Russia on the battlefield cannot win. It will not sustain occupation of Ukraine. So what they want to do is break the spirit of Ukrainians by making their life hell. Based on your knowledge of Ukraine, your conversations with the Ukrainian government, is that going to happen, or will these people say, we'd rather freeze, but we want nothing to do with Russia?
Well, there is a very strong determination in Ukraine. We also saw it in Kiev, that people are really ready to resist, but we need to provide them with necessary support.
And just as a final question, especially now we have our international audience, European, American also, but a global audience that at times finds it difficult to figure out what's going on in the situation. Once again, why is it important in your view that Ukraine ultimately emerges victorious for this? What are the consequences if Ukraine fails and Russia prevails?
Indeed, it's not only a conflict between Russia and Ukraine. It's really Russia is not hiding it, that it's in an imperialist mood, that it's going to invade other countries. So the conflict is going to spread. So it's important to stop this Russia's aggression, to stop the spreading of the war. So in a sense, it's not Russia against Ukraine, it's autocracy against democracy. It's about entire European security architecture and with repercussions across the world.
Mr. Dombrovskis, thank you so much. As always, appreciated your time on Bloomberg TV. And of course, Lisa, that was Valdis Dombrovskis, Executive Vice President for the European Commission, also handles trade. And again, he's making a very important point. The situation on the ground in Ukraine, we talk about people that do not have heat and that do not have electricity, do not have water in 2022, almost incredible scenes in the heart of Europe.
Yeah, heartbreaking. Maria Tadeo, wonderful work. Thank you so much in Brussels with European Trade Commissioner Valdis Dombrovskis. Coming up, the morning calls, and later, Allsprings and Mileti seeing opportunities amid continuing volatility. That conversation still ahead.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one, and through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
This is Bloomberg Markets, the open time now. Look for the morning calls. Look at some of the analyst recommendations on Wall Street this morning. First up, Argus cutting its price target on Lyft to $17 from $41, citing concerns about the recent sell-off following a round of layoffs. Next up, UBS cutting Man Group to neutral. Analysts warning of a potential impact from an upcoming pension fund de-risking process. And finally, Credit Suisse raising its price target on Deere to a street high of $582, following a strong earnings beat and positive outlook. Coming up, the open. This is Bloomberg.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
This is Countdown to the Open. I'm Lisa Rollins in for Jonathan Farrow. Moments away from the start of trading, if anyone's actually trading, because right now things are pretty much stasis, perhaps stasis to the downside. The Nasdaq down about 0.5%. You've got the S&P lower by about 0.1%. It's been a bit of a reversal, but let's not make anything serious about this because it is a quiet day. If you want to take a look at the yield space, perhaps this is the story behind the Nasdaq. You are seeing yields marginally higher, 3.73% on that 10-year after an incredible retracement, a rethink of how high yields could go over the past couple of days. Crude's higher, $78.34 on the NYMEX, and the euro-dollar pretty much range-bound, but you are seeing a bit of dollar weakness, dollar strength, a bit of euro weakness, 103.63. It is one of the busiest days of the year for retailers. Companies bracing for Black Friday in the face of higher inflation and souring consumer sentiment. This coming as thousands of Amazon workers prepare to take part in protests and walkouts across 40 countries. One of the campaign's organizers saying, quote, "It's time for the tech giant to cease their awful, unsafe practices, immediately respect the law, and negotiate with the workers who want to make their jobs better." For more, Bloomberg's Ed Ludlow joining us from LA. What's the latest, Ed?
Yeah, good morning, Lisa. I hope you had a good Thanksgiving. Interesting about Amazon is how widespread the action is. 40 countries are expected to see Amazon workers strike or protest. This is a globally coordinated initiative between a number of unions, interestingly led by unions out of Europe. Such a big story for Amazon in 2022, especially here in the United States, the traction that the union movement has had amongst its workforce at a time where some of the third-party data tells us that this Black Friday in particular could be a little softer for Amazon in this key holiday shopping season. One reason being that they held an earlier Prime event in October, which brought some pull forward in consumer spending. The other really big tech story we're watching is Twitter. According to sources in Brussels, Lisa, the remaining staff, just a handful of them, are now gone from that office. But this is critically important because, of course, Twitter faces regulatory questions around the world, but in the European Union in particular, when Musk closed his deal to buy the social media platform on October 28th, it was members of the European Union's leadership who were most vocal about saying that Musk and Twitter had to, quote, fly by the EU's rules. So, you know, it's interesting they do not currently have staff there dealing with these policy issues. And I think Musk tweeted just overnight that they are going to go ahead with the verification launch next week. And he gave some explanation as to how they'll do that. But a lot of content moderation questions right now for Twitter.
Ed Ludlow, thank you so much. Luke Kawa of UBS has been betting on cyclicals. We caught up with him earlier this morning. Take a listen.
Where we do see kind of room for more progress in environment is value cyclicals relative to defensives in particular, relative to kind of more high growth tech stocks, and see a lot of scope for continued gains there. And this is just when you're kind of pricing in the degree of pessimism you see now for 2023, then anything that's better than that looks like a very good news story on the cyclical front.
Back with us, I'm so pleased to say, Aberdeen's Luke Hickmore, and also joining us, Allspring's Ann Maletti. And we were speaking earlier with Luke, and I want to get to him on this in a second, about how some of these margin compression issues are going to become more acute heading into next year, especially in the retail sector, as we just heard, places even like Amazon dealing with worker pushback in the face of inflationary pressures for them as well. How is that affecting your view of the consumer discretionaries, the cyclicals that a lot of people are saying could look good?
I do think our investment teams are a little bit more positive, I would say, on the cyclical areas, but not so much the e-commerce, consumer discretionary areas. And I think it's because of the extreme growth we saw. If you look at Q4 2020, for example, the growth that we saw in e-commerce in that quarter was the equivalent of the growth that we saw over the past 17 prior quarters. So 450 basis points of growth in one quarter. And that was obviously a big pull through, obviously COVID related, but now it's just normalizing. And, if we're headed into a recession, will we see more compression instead of just normalization? that's kind of a reason why we're seeing some of the challenges at the online retailers, I think.
Luke, do you see a distinction between online and in-store? Do you see some sort of differentiation, or do you think that this is going to be a wholesale reset when it comes to earnings per share based on some of these conflicting issues of inflation plus workers demanding higher wages?
So 2020, 2021 were massive years for online sales growth, and I think it brought forward growth of online shopping by 5-10 years in terms of its penetration of total retail spend. So yes, to a degree, but they're going to face exactly the same problems as the bricks and mortar retailers, getting those margins right, keeping their costs down, kind of driving forward rather than being held back by wages. I think that's no different now for online to as it is for bricks. So to some degree, yeah, they're going to have a good Black Friday. They'll have people hunting down deals like they were everywhere else. But I also, the whole retail industry's got used to what the online does and how you respond to that sort of bricks and mortar side of things. So I don't know. Some of me feels it's a 2021 question.
Interesting. Basically, at this point, Amazon's like any other retailer. It just has the cloud computing system that's going to also support it. Luke, from your perspective, if you are going to see this earning per share, this EPS compression heading into next year, which asset class, which region of the equity market do you think has least priced that in?
I still think you've got to be chasing income equity. Maybe that's because I'm a bond guy, a credit investor, and that's really what I'm all about. But I think if you can get decent quality balance sheet, protectable margins, good track record on dividends, and keeping them high, that's the kind of way you survive these kind of equity moves and tougher and tougher EPS projections as we go through 2023. So probably value for me over growth.
And from your perspective, how much are you looking at bond substitutes or things that can generate income at a time when yield is once again a thing?
I do think income is going to play a role here, both in the fixed income market, but also in the equity market as well. We are seeing investors who are looking for more equities where you can find, dividends as well. But I wouldn't discount equities totally. We are seeing broad-based multiple compression that happened. We do need to see more earnings be taken down, right? We have not seen that. We just started to see it this quarter. We need to see more earnings just get more into check here. But if you're an investor and not a trader, there are a lot of opportunities in the marketplace. What we're expecting, though, is for fundamentals really to matter going forward. It's going to be a recovery that companies are going to have to earn. You're not going to get the V-shaped recovery that some may be expecting from policy or the Fed. It's going to be ones that are going to be organic, that companies are going to need to see some growth, whether it's a value company seeing very modest growth or a growth company generating some top-line growth. But they're going to need to earn that growth, and it's not going to be given to them.
Meanwhile, I do wonder, Luke, from your perspective, you believe that the Fed is going to start cutting rates next year. And from the credits perspective, do you think that that's going to be a complete boon? That basically, we're seeing the recession right now. The Fed's going to pivot really early and then cut rates, and then all of a sudden you get credit outperforming and having the best year of decades.
Possibly. I think it depends which credit market. I like EU, I like GBP. US feels for me that it's got a little bit of lifting to do in terms of where it is and where it should be priced for the problems coming down the road. I mean, as you've been discussing all afternoon, a lot of people thinking we just avoid a US recession. That's not where I am. I think we do get a recession in the US, in which case US IG is not priced yet. But I think there is really good value. And with Anne, I completely agree. Credit, much like equity, there are opportunities all over the place. Dispersion has got massively higher over the last few months. As an active investor, that's just great.
Meanwhile, Michael Hartnett, Bank of America's strategist out there, highlighted that the largest inflow into bonds in the past 15 weeks. That's what we've seen. Long bonds, H1. We stay bearish risk assets in H1, set to turn bullish H2 as narrative shifts from inflation and rate shocks of 2022 to recession and credit shocks in H1 of 2023. When you go macro, Anne Maletti, when you take a look at the bigger picture, where do you agree with this and where do you push back?
Well, I do think that we are really, from a macro standpoint, our investment teams do believe that things are going to get a little bit tougher here, that the Fed is pretty serious, but we do also think that they will pause when it comes time to actually seeing that the work they've already done has taken hold. They will pause. But we don't think, again, that they're going to give us those rate cuts immediately. And that's why I said companies are really going to have to earn the right to go up. The stocks will go up, the ones that deserve it, but not all of them. And that does present a lot of opportunity for active managers. And so I think we're really, really well positioned from that standpoint.
Anne Maletti, you'll be sticking with us. Luke Hickmore, thank you so much for being with us and have a wonderful weekend. Back with us with a look at the stocks moving at the opening bell. Here's Ed Ludlow. Ed.
Yeah, taking a look at Apple, interesting that it's now under pressure following the protests in Zhengzhou earlier this week. The principal site of its iPhone 14 and iPhone 14 Pro production now down 2% after a Reuters report overnight that production would be impacted to the tune of 30% in the quarter. Also seeing shares of Activision Blizzard down 3.5%. A report from Politico that there is consideration from the FTC to make an intervention in Microsoft's deal to buy Activision Blizzard that could come as soon as next month, the stock reacting to that. Schlumberger had been higher actually, but now down 0.6%. Generally, we saw energy and oil stocks push higher as Brent and WTI edged higher. And really interesting on this one, Lisa, Manchester United continuing its surge up 11.8%, 12% after comments from Prince Abdulaziz bin Turki Al Faisal to the BBC that the Saudi Arabian government would support any private Saudi bid to buy that company. Of course, we learned this week that Manchester United's owners, the minority stake owners, the Glazers, are considering all financial options for the club, including selling that minority stake.
Ed Ludlow, thank you so much and have a wonderful weekend. If I don't speak to you before then, coming up, a record number of COVID cases clouding China's reopening path.
I think the end game is that China will probably, by second half of next year, accelerate with regards to growth helped by the reopening. But the path to that could be incredibly bumpy.
That conversation coming up next from New York. This is Bloomberg.
When the price of anything goes up, the consequences reach far beyond what you'd expect. But perhaps most of all, when it comes to food. In 2010, surging food prices helped spark the Arab Spring. Lives were lost, regimes fell, and the consequences are still with us. Once again, food prices are rising, and fast. Energy costs, broken supply chains, and surging demand were just some of the factors that have driven food prices to their first record high since the Arab Spring. And that's all before a war between two of the world's biggest food producers. Ukraine is called the breadbasket of Europe, and taken with Russia, the two account for about a quarter of global wheat trade. They produce more than half of the world's sunflower seeds and oil, nearly 20% of the barley. Now throw in rising energy prices, and processing, transporting, even refrigerating food gets more expensive. Plus, fertilizer production is extremely energy intensive. Less fertilizer means lower crop yield, and prices rise even more. The pandemic revealed how complicated and fragile global trade systems are. Global agriculture, perhaps even more so. Unlike metals, for example, food goes bad, and crops take months to grow and are vulnerable to unpredictabilities like the weather. Rising food prices will be felt everywhere, but the poorest countries in the world will be hit the hardest. And as all these factors compound, the real fear is that record high will lead to record high, and ultimately to a global food crisis with vast consequence.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
I think the end game is that China will probably, by second half of next year, accelerate with regards to growth helped by the reopening. But the path to that could be incredibly bumpy. And the real reopening, we always thought would occur kind of around Q2. And as you see those cases go up, you could say that, yeah, the risk is definitely that it's being pushed further out.
It is certainly a bumpy ride right now over in China, with uncertainty looming over how quickly they can reopen among another record number of cases reported. This as protests at a top iPhone manufacturing plant threatens to impact production by as much as 30%. Team coverage starting right now. Bloomberg's Deirdre Hipwell in London alongside Ed Ludlow in LA. Deirdre, from your vantage point, how quickly are we seeing the cases accelerate in China? How significant is the COVID issue?
The cases are really rising. I mean, they're at a record high, and this is really unusual for China because this is a country that has restricted personal freedoms and really locked down its citizens. So what they're trying to do now is trying to ease restrictions, but at the same time contain the cases, and it's causing a lot of widespread confusion, which is what we're seeing, you know, with the situation at Foxconn and what's happening in Beijing. It's a really difficult tightrope.
Meanwhile, we are seeing, Ed, the impact on U.S. businesses that do a lot of their manufacturing in China, in particular Apple. What has the guidance been out of Apple trying to gauge out the damage from the uprisings at their Foxconn factory?
Yeah, we're talking about the Zhengzhou facility, right, which is operated by Foxconn, a contract manufacturer. It's important because it accounts for 4 out of every 5 iPhone 14s that are made, particularly the iPhone 14 Pro. We had protests earlier in the week. The official line from Foxconn was that those protests were quickly brought to order and that the facility was operating normally. But you had the Reuters report overnight that this would have an ongoing impact, which would reduce production by around 30% in this current period, in this quarter. Beyond that, there are some longer-term issues here, right, which the protests came as a consequence of what are very tight COVID zero curbs. You saw authorities in Zhengzhou extend those restrictions to 8 districts in the city. And now you're wondering how the Chinese government in particular balances the control of this virus with the economy. And of course, the big news overnight, the RRR cut. In other words, China's central bank, the PBOC, basically reducing the requirement on lenders in terms of the amount of cash they have to hold in reserve, some form of easing. But the situation is still complicated as it relates to global supply chains, and Apple is a pretty good barometer, right, of the impact this is having on what is a central region when it comes to tech production.
Ed Ludlow, Deirdre Hipwell, both of you, thank you so much. And Melody back with us. And Anne, I really do want to focus on the tech sector and how much of some of the disruptions over in China, both from the production standpoint as well as the demand standpoint, have impacted your forecasts for some of the tech giants. Have you really factored this in or started to reset how much you have to consider it heading into next year for the likes of Apple?
This is something that we've been speaking to our emerging market managers about a lot, and more so not just for the emerging markets, but obviously the impact that it can have across all of the strategies that we manage at Allspring. And the interesting thing when we talk to them, not that China is the U.S. in any way, shape, or form, but if you think about some of the similarities that we had when we were emerging from the lockdowns we had, right, state by state, there were a lot of start and stops, a lot of changes to policy, a lot of confusion. And I think, based on what we're hearing, and again, the information flow from China is not always crystal clear, but what we're hearing are a lot of similarities, a lot of challenges, a lot of confusion. And so I think I would expect to see that. I would expect to see a very bumpy road, a lot of, okay, we're going to do it this way, and now we need to make some adjustments. And so that will present some supply challenges, and it will, potentially impact demand. But demand is challenged in the U.S. because we are seeing the real impact of inflation here. Right, so our investment teams are working to balance all of those issues. And in some ways, because there's less demand, we believe coming in 2023, maybe the supply challenges are less problematic than, a year ago when we had really, really challenging demand.
So in other words, just to sort of consolidate this down into your view in terms of pro or con buying some of the big tech names, do you see an opportunity here after the sell-off this year, or do you see that there are just too many issues pockmarking the landscape?
It's risk versus reward on every single individual name. And I think that's where you have to really be careful in a market like this, is to generalize too much. Because if you just say technology, if you just say semiconductors, if you just say big tech, you can miss really great opportunities. So for us, it's looking name by name and trying to find unique opportunities that might be getting thrown out because of generalization.
And Maletti, thank you so much for being with us. Have a wonderful holiday weekend. Let's right now head back to Ed Ludlow to get some sector price action this morning. Such an active morning, Ed. Parse through it and give us something to talk about.
Well, thin volumes after Thanksgiving, but let's go to IMAP Go on the Bloomberg terminal. And basically energy, kind of one of the most interesting sectors this morning, in large part because of reports that the European Union is seeking to boost the curbs on Russian crude. Higher oil means higher energy stock prices. Otherwise, we're very much focused, of course, on consumer and discretionary as we head into what is essential, a crucial part of the holiday shopping season, not just for names like Amazon, but legacy retailers as well. And you see some of that playing out across the equity sectors this morning. Lisa.
Ed, thank you so much. Indeed, it is quite an active day here as people reset with their tryptophanic trances. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. In the markets, wow, look at that. It's completely flat. 40.2693 on the S&P. This is Bloomberg.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Welcome back to the Open, and we're taking a look at markets that are somewhat range-bound. You're seeing the S&P basically flat, the NASDAQ down about 0.6%. Really, the action has come earlier in the week when we saw that real drop in yields. Take a look at 10-year yields. Week to date, you can see that they have been declining, and today we're seeing a bit of a bounce back, but really this has been the trade of the week. We've gotten people saying, go into duration, and so they have. You've seen dollar weakening, and that's been pretty persistent. We've seen that for a while, and you could see that continuing on the margins in terms of people's outlook. And then take a look at the 2-10 spread, this gap between 2-year and 10-year yields. It has contracted to the biggest inversion going back to 1981 this week, and that's underpinning this idea that yes, the Fed will hike, but perhaps growth will slow so quickly that we might be able to avoid a hard landing. Time now for a trading diary, what you need to be watching. The U.S. stock market closing early today at 1 Eastern. Looking ahead to next week, Fed speak, Williams, Bullard on Monday. On Tuesday, we get Conference Board consumer confidence, U.S. GDP, and core PCE coming on Wednesday. Plus, Fed Chair Jay Powell speaking along with Governors Bowman and Cook. Finally, initial jobless claims on Thursday, and rounding out the week, it is Jobs Day in America on Friday. This was Countdown to the Open. Have a wonderful Thanksgiving weekend. This is Bloomberg.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We are seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
The top names in climate change are on Bloomberg.
Building out local wind, local solar, hydrogen, these are solutions to not just climate issues, but geopolitical issues.
We are in a position by 2030 to have 80% of all electricity generated by wind.
Renewables are the safest, the cleanest, and the cheapest form of energy today, especially for countries such as Greece.
Nobody covers climate change like Bloomberg, your global business authority.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard In America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010 after staying for almost 1 year in the hospital. He died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. and it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Benegold as an opportunity to leave that troubled home. Benegold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Benegold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Wienergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Wienergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech and write up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was